most of our folks will will want to get out of here by 1 o'clock. Okay, so here we go. Our objectives today, we are going to, it's California centric. And so that means we're going to spend time on the California return, California topics. So we're going to review the deductions, the exemptions, and the dependency exemptions. And then we'll talk about the California healthcare mandate. And if you remember back in 2010, the Affordable Care Act was passed by Congress and signed by the president. And that particular piece of legislation, it did a lot. It's a voluminous piece of legislation, well over 1,000 pages. And one thing it did do, it set up the exchanges. We call them the federal exchanges, where you could purchase healthcare. And California made it mandatory in 2020. And then, of course, most of us know about Covered California. This is something that you're going to see at the VITA site. People have different types of health insurance, and a lot of low income and moderate income folks have signed up with Covered California to have health insurance. And then we'll talk about the filing information and filing statuses. And usually I tell when people come to the VITA site, they're there to get a return file. They may not have a filing requirement, but they most likely have credits, refundable credits that they're entitled to. And in order to get a refundable credit, whether it be federal or state, you have to file the return. And then we talked about some selected income items. We'll talk about the California itemized deductions. And when you are talking about itemized deductions, they are different than the federal deductions. There's some similarities, but there are differences. And then we'll go through some of the various credits, the refundable and non-refundable credits for California, and review the 540. If you're familiar with other types of California returns, again, we're not going to do an NR. We're not going to do a part year, because we only work with California residents in the VITA program. And then we'll talk about that Schedule CA that you'll see from time to time. And then other California topics, and then we'll get into details on a tax return where the individuals are California residents. They have some California credits that they're entitled to, and we'll go through that also. We are focused on the tax year 2022 today because, as Sean said, 2023 is not up, so we don't want to confuse anybody. But when you do certify, you'll be certifying in 2023. And when you're at the VITA site, you will be preparing primarily 2023 tax returns. And then, of course, it's up to the site coordinator. Typically, you might have a taxpayer come in and they may say, hey, I've got a couple of returns that I haven't filed, i.e. 2022, maybe 2021. And typically, Sean, I'm not sure of your policy, but my policy at my VITA site, if they come in with a return and they want 2021 or 2022 done, we typically will prepare that return for them.
Yeah, we'll go back 2 years if they have all the documentation.
Okay, all right, very good. All right, and so our Zoom session, we're going to knock off a little bit early. And yes, I do recognize, at least I think the Army-Navy game starts at noon California time, Pacific Standard Time. So we'll knock off a little bit early. Our breaks are going to be approximately on the hour. Okay, we want to continue to show this page because it's important to know the cast of characters, who's who in the zoo. And so if you are from St. Killian's or working at St. Killian's, your go-to guy is going to be Sean. He's going to be the site coordinator. And then you also have some other players to include Robert Andrews. Robert is an assistant site coordinator at St. Killian's. He also works for me at Garden Grove, so he'll be a busy guy. And he's also in my tax class, so he'll have some tax knowledge before the end of the year. And then Emily, she is a known quantity. She's our ERO, and she works both at St. Killian's and at Garden Grove Coastline College. And then we've got the other players to include our IT folks. And we've got John, our training coordinator. I believe Evelyn is still going to join us for the, say again?
Sorry, I was coughing.
Okay. I think Evelyn's going to join us, and then we have the other folks, Art, Mel, and Susan. And then excuse me, Art, Mel, and Fred. And then when you hear the name Susan, she's the business manager, she's the money person, and she does a pretty good job. Okay, I think that's it for the players. Sean, any new players that you want to announce?
Um, no, we don't have any news players. We do have some. We had some recent examples where another site is trying to uh, volunteer some of our players to go work there. So I'm not sure what's going on with that.
Well, I guess the answer to that would be just say no if you don't want it.
Yeah.
And I'll do a shameless plug for the Coastline College in Garden Grove. We'll be operating on Fridays, and so we won't be poaching any folks. And so if you're remotely interested in working as a VITA volunteer on Fridays, we start at 10 o'clock, knock off at 1, and you can contact me and we'll put you to work, especially if you're certified. Okay, so here are some of the references for California, and we're going to go through that sitemap a little bit today. The sitemap, I stumbled upon that, I think maybe last year or maybe a year or two ago, and it is an excellent reference because it talks about just about anything you want to know about California. Although we're focused on individual returns, there's information regarding not only individual returns, but also business returns. And that site fairly recently updated, and that's something that I guess I've learned over the years. You might have a site from a governmental entity, i.e. the IRS, the FTB, some other type of agency. I go to the bottom of the page and see when it was updated. So again, fairly recently in September. And then the 2022, I've gone all over the website. I can't find a 2023 California return, but no harm, no foul. We're focused on 2022 because the software right now doesn't show 2023. And then that personal income tax booklet for California, it's kind of like the instructions to the Form 1040 for the IRS. That particular booklet is very detailed, and it has line by line instructions. And then a go-to document, we know about the 4012 for the IRS for the Form 1040. The go-to document for a California return is the California Volunteer Reference Manual. And the 2023 will show you bits and pieces of that today. That's been published. And that's something that when you're at the VITA site, in addition to certain other documents, that's something you want loaded up on your computer, or you want to be able to access that. And that does a pretty good job talking about California. I recognize that as of present, the St. Killian's is not going to prepare military returns. If that does happen, then of course you're going to have a number of people to be certified. There's an entirely different manual for military returns, and that 2023 has been published. So again, keep in mind, once the site coordinator approves additional training, then you're going to have multiple people certified. And that military training manual, again, has been published. And then this is something I think I've used it maybe one season, the VITA knowledge check from the state of California. If I recall, it's 15 questions, something like that. And Sean, that'll be up to you if you want to make that mandatory, but it's pretty basic. And so once you have the California training, you'll be able to breeze through that knowledge check that appears on the screen. Just like the IRS, the Franchise Tax Board, they have many, many different types of publications, and probably the one or maybe a couple of them that you might spend a little time with is the Pub 1001, and it says supplemental guidelines to California adjustments. Or stated differently, the 1001 talks about conformity and nonconformity. And you'll hear that not only in VITA, but also in the tax world. And all that means is the federal government, they pass tax legislation. And a lot of times California will essentially piggyback on that legislation. They'll conform to that. And that's called conformity. And then sometimes you'll have the federal government pass legislation. So, for example, uh, unemployment compensation. Unemployment compensation is fully taxed by the federal government in tax year 2022, 2023. It is not taxed by the state of California. So that's an example of nonconformity. And then you do have a lot of people who come to the VITA site who are seniors. And typically, when we say seniors, usually you're talking someone who's 65 or older. But again, you have people who are getting pensions who are younger than 65. So that 1005 does a great job talking about pensions. And then for the individuals who claim the California EITC, what happens is sometimes the state of California says, but we need additional information. That happens all the time. So a letter will go out to the taxpayer, and what that means is the franchise tax board is verifying something. And so what that means is before a refund can be issued by the state of California, sometimes they're going to need additional information. So the form 4502 goes out, and that means your taxpayers may not get that refund straight away in late January or early February until additional documentation is obtained. And that's pretty typical. I've seen that a lot. Different types of letters go out by the state of California. And then when you're talking about Covered California, I have not signed up for Covered California. I don't even know if I'm eligible. But when you hear the term Covered California, usually you're talking about low and moderate income taxpayers. And what they do is they go into the site, or they have what is called a navigator, someone to assist them. So they go into the site, they populate the site with their information, their data, and they buy health insurance, and that health insurance is subsidized by the taxpayers. And then what happens is, because this is a mandatory thing with the state of California, if you don't have health insurance, then you have to obtain an exemption. And if you cannot obtain an exemption, then you have to pay that California individual share responsibility penalty. Which for some people, if probably not VITA clients, but for some, it's going to be a few dollars, meaning it's going to be significant. And then when you're talking about the federal government, I can't remember how many years ago, but the Congress repealed the federal individual share responsibility. So that's something that does not appear on a federal return. Okay, any questions about these references, publications, forms, instructions? And Sean, have you thought about that knowledge check? Is that something that you're going to ask the volunteers at St. Killian's to take?
I haven't thought about it yet, but we do. I'll just mention we're providing training from the franchise tax board on the first Saturday in January. And when we get
Is
a
that
link,
via Zoom?
it's going to be via Zoom, and we'll send out the link to everyone whenever the state sends me the link.
Yeah, that's a good point, because when you're talking about California, there's a lot to know about individual income tax, i.e. that Form 540. So if you can attend it, that would only benefit you. All right, so let's go ahead and do this then. Let's go ahead and see if we can go to the sitemap. And Sean, let me know if you can see the sitemap that I'm going to bring up.
I'm still seeing your PowerPoint, Jerry.
Okay.
Michelle,
What about now?
still see your PowerPoint.
All right, and we're gonna go ahead and go to the internet, and I'll bring up the sitemap here.
It may be that you selected your PowerPoint for share screen, so it's only sharing your PowerPoint. That you probably have
That does not surprise me. I am not an expert at Zoom. I have a basic working knowledge. All right, so let me go ahead and do this and see if we can get this, because this is a very important site. I think it's an important site. So give me just a second here. All right, stop sharing, and I'll bring that up. All right, what about now, Sean?
Yes, we see it now.
Okay. All right. So this is may not be the end all be all, but it's certainly a place to go to obtain information about California. And as you can see on the very top, you can see it has a number of items to include credits, filing status information. So we're going to focus on a few things this morning regarding the sitemap. And so over on the left-hand side, it talks about after you file a return. And these are questions I receive each and every season. And it's almost, I would say probably something you get from almost every taxpayer. They want to know, do I need to keep my records? And the short answer is, yeah, you want to keep your records because obviously in the unlikely event, and most people do not get audited. If you actually look at the numbers, low and moderate income taxpayers, yes. Do they get audited? Yes, they do by the IRS and the Franchise Tax Board, but it doesn't happen that often. But the important thing is you want to keep your records because if you ever have to sit down with someone from the Franchise Tax Board, and they're asking questions, you have your records, then usually no harm, no foul. You're able to get past that. But keeping your records, it talks about that after you file a return. And then, of course, this happens all the time. And this is based on your site coordinator. Once someone files their return, they may say, I forgot something. I forgot a piece of income. I forgot a deduction. And I need both my federal and my state tax returns to be amended. And that's something that's really a site-by-site decision. And so if Sean decides to amend returns, so be it. You'll have a small cadre at the church who will be trained to do that. It's not impossible to amend a return, but it takes a few additional steps. And my policy at my site is, yeah, we do amend returns, but usually toward the end of the season.
Yeah, Jerry, we do it the same way. They wait until the very end of the season.
Okay. And that's why I think the takeaway there is the individual who comes to the site, they're going to provide all the documents, and then you're going to ask them, is this everything that you have? And sometimes it'll jog your memory. Whoops, I'm missing a W-2. I had a job for a week or two. Let me go back and get that. Or no, I got some interest income that's reflected on a 1099 INT. Let me go back and get that. So again, that's something that happens all the time. And then also we get a lot of questions about audits. And I always tell people, yes, again, you can get audited by the IRS and the Franchise Tax Board, but when you get into the numbers, very few people are audited because the IRS is a very small organization. It doesn't have 10 million employees. It has well below 100,000. And in addition to doing audits, they also do customer service. They do computer stuff. They do all sorts of stuff. So usually you're not going to get audited. But if you do get audited, a letter goes out from either the IRS or the Franchise Tax Board. Dear taxpayer, we're going to look at your 2020 return, whatever the case is. Of course, the statute has to be open. You'll hear that from time to time. And then an examination usually takes for an individual maybe a couple hours, if that. And then what happens is both the federal government and the state government, if they make changes, then what is called a proposed assessment or proposed adjustments goes out in a letter to the taxpayer. And then the taxpayer has an option of either writing a check or contesting that proposed assessment. And as I've mentioned before, we show our taxpayers the way, but we don't advocate for them. And so I've had taxpayers call me up and say, hey, Jerry, I'm getting audited. Okay. What can you do for me? Well, I can tell you the basics of an audit, but I'm not going to represent you because again, we don't advocate in the VITA program. So that's something you want to stay away from. I use the terminology, show them the way, because most of us on the call here, if we've been in VITA for a year or two, then we know some basic stuff that we can share with the taxpayer, and no issues there. But again, we don't advocate. All right, and then you can see there's business stuff. You're not going to worry about that business stuff because we don't prepare corporate returns in the VITA program. We don't prepare partnership returns in the VITA program. And so you can see all of the various business credits, and there's a lot of business credits. But again, we don't do that in the VITA program. All right, we're going to go down to the bottom. You can see all the stuff there for businesses. And It goes on and on. So we'll pop up here and we'll
Oh,
look
there was
at
did not
the,
file at the bottom there, Jerry.
what's that?
There was a right below business. There's people who didn't file their taxes.
Yeah, for business tax returns. And here's something when you're talking about filing a return, a lot of people say, "Hey, I didn't file my return." Well, what you've got to determine, do they have a filing requirement? And in the VITA program, some people don't have a filing requirement. So this is my philosophy. If you don't have a filing requirement and you're not entitled to one of the credits, then don't file a return. But if you don't know, then go to the VITA site and say, I want to file a return. What we do at my site is anybody who walks through the door and wants to file a return, and they're under that approximate $64,000 of income, we file a return for them to include individuals who are Social Security recipients, and that's all they have. And again, I've had this discussion again and again and again. If you walk through our doors, we're going to prepare a return if you want a return, but we'll notify the taxpayer once we look at their data, say, you don't have a filing requirement. And a lot of taxpayers say, I don't care, I want to file, and we will file a return for them. And Sean, I don't know what your philosophy is at St. Killian's.
That's definitely our philosophy since the IRS increases our goals every year by 10%.
And of course, I'll use the term taxpayer education. It's important if you've got tax knowledge and someone has questions regarding tax, federal tax, state tax, then you can share that information. What I usually do, someone asks me a question, I'll go ahead and find the respective federal or state publication, and then I'll share the snippet or the paragraph or the line with the taxpayer, so they have a little knowledge when they walk out the door. Okay, so you can see at the very top on the right-hand side, information regarding the California Earned Income Tax Credit. And you can say, or you can see it says calculator. And so that's something that you can go through with your VITA client. And then it has a laundry list of various credits, and these credits include both non-refundable and refundable credits. And when you hear the term non-refundable, what that means is it's a dollar for dollar reduction of the tax, and there's no additional monies that are going to the taxpayer. A refundable credit, and a lot of our VITA clients want those refundable credits. And that means they may have a zero state tax liability, but with a refundable credit, they're going to get money back. And one of the big refundable credits in California and also for the federal government is the Earned Income Tax Credit. And as I mentioned, I think I mentioned this last week, the rules for California EITC are different than federal EITC. So you may have a taxpayer who is obtaining the federal EITC, and they're looking at you and they go, well, why not state? And you say, well, the federal government and the state government, two different entities, and there are different rules for both of those credits. And then, yes, sometimes our low income taxpayers get both the federal EITC and the state EITC.
Hey,
And
Jerry.
if you're fairly new to the VITA world,
Jerry, we had a
you may have,
request. If
sure.
the screen it's a little hard to read these fonts because they're kind of small. Could you possibly expand the fonts on this page?
Yeah, let me try that. Let's see. Does
Thanks.
that help out a little bit, Sean?
That does. Yeah.
Okay. All right. So some of the credits that you may have heard about, or maybe you haven't worked with, there's one that's fairly new. I think it's been around a few years, the Foster Youth Tax Credit. And we're going to talk about that today. If you meet certain requirements, you get that particular credit. And then other types of credits, similar to the federal one, the Child Independent Care Expense Credit. Again, there are similarities, but the state of California and the federal government, two different entities. And so you have to meet the requirements for California, in this case, Child Independent Care Expense Credit. And then the Young Child Tax Credit, that's something you see a lot of. That's a pretty healthy credit. If I remember correctly, it's well over $1,000 if you qualify for the greater amount. And that would be for kids under 6 years old. And then there's a discussion, although we don't do this in VITA, because when people come to the VITA site, we look at their documents, we ask them questions, and if they provide us with a W-2, That means they're a wage earner. So typically we're simply going to enter that data into the software. If someone comes to the VITA site and they use the term, I'm an independent contractor or I'm a consultant, then after a few questions, we make a determination that they are self-employed. And as I've always said, I can only think of three different types of taxpayers, individual taxpayers. You've got wage earners, you've got self-employed individuals, and you have investors. I can't think of another one. And so when our clients come in, they're either one or two or all three of those different types. And so the term independent contractor, when someone uses that, that means they may have a 1099 NEC issued to them, non-employee compensation. But as we know, sometimes taxpayers who work, they don't receive those information returns. And I always put on my hat for either federal or state. If you have received monies and those monies are included in gross income, it doesn't matter if you did or did not get an information return, that's going to go in your tax return. And a lot of people are married to those information returns. They figure if they didn't get an information return, they don't have to report the income. And I tell them, no, that's not the case. We do not prepare many different types of returns. We don't prepare estate and trust returns. I get those questions all the time at VITA sites, and I simply tell the client, we don't do those returns. If you need an estate or a trust return to be prepared, then you need to reach out to a paid practitioner. If you want to do it yourself, good luck. Of course, you'll go ahead and get the instruction booklet, and you'll do a lot of reading, and you'll prepare your own return. But we don't do that in VITA. And I think I said this before. A lot of taxpayers said, why not? And the answer is we're not trying to do that. That's not part of the program. We prepare basic tax returns. And like my wife says, if you go to your mechanic and your mechanic is not trained on repairing brakes or replacing brakes, and you go there for a brake job, and the mechanic says, I'm not trained to do that, then you're going to turn around and you're going to walk away quickly and go find someone who is trained. So again, we don't do that, not part of the program. There's a lot of things in the tax world that are not part of VITA. And again, we just look at the taxpayer and have that warm and fuzzy conversation and tell them, we don't do it. We're not trained. This is the individual share responsibility penalty estimator. And this is something that taxpayers can go through or a preparer can go through and show their VITA client what they may end up paying. A lot of our VITA clients do not pay that California individual share responsibility penalty. Some of them do because they don't have insurance and they don't meet one of those exceptions. So again, that's a good thing to get into. Let's see. Down here again, healthcare. We ask about this on the 13614C, and there are many different types of ways to get healthcare. And so I can think of a few. One, you can be a low-income taxpayer in California. You can apply to the state of California for Medi-Cal. And if you qualify, then you have health insurance and you're not paying anything out of pocket for that insurance. A lot of our taxpayers, they've got health insurance through their employer, and they meet the minimum requirements for the Affordable Care Act. You've got veterans that may use the Veterans Administration. A lot of our clients are seniors, and so what that means is they sign up for Medicare, and of course they pay their premiums, which are reflected on the SSA 1099. And so those are some ways to get health insurance. Another way is you can pick up the phone, you can call an insurance company and say, hey, I want health insurance for me and my family, and negotiate and sign the contract and pay the premiums. But those are some ways to get health insurance. And you will see people, I see them all the time, that do not have health insurance. They either cannot afford it or they simply don't care. I meet a lot of youngsters, meaning ages 18 through 25, and they simply don't care. And so that means they don't have health insurance. And if they're filing a tax return, then if they meet one of those exceptions, then they do not have to pay that California individual share responsibility payment. This is something you probably won't bump into I've only seen it maybe about a half a dozen times, but when you have a taxpayer that comes to the VITA site who happens to be a Native American, and as I've mentioned before, there are special populations in both the California tax world and the federal tax world. And those special populations have special rules that apply to them. And so, for example, if you are a member of the Armed Forces of the United States for California, California treats them as a special population. There are special rules that apply to members of the armed forces. Same thing with Native Americans. And so again, if you bump into a taxpayer who happens to be a Native American, and what you can do, you can go to this portion and you can make a portion of the site map, and you can make a determination if you need to do any further digging. Self-employed, of course, we know on the federal side of the house, there's a Schedule C as in Charlie that is generated in your software. There is no such thing as a California Schedule C for self-employed individuals. And so again, we have we simply prepare the Schedule C on the federal side of the house, and then the income will populate on the net income, I should say, will populate on the California return. Down here, you do have information pertaining to a decedent, and you do see this from time to time. And so what that means is when the VITA client comes in and they've got typically an adult daughter or son that has passed away, or maybe a brother or sister, and what they're doing is they're filing a return typically to get a refund that was due to that decedent. And so, of course, you would obtain the death certificate. On the federal side of the house, you would complete an IRS form 1310. But again, at the end of the day, we do assist individuals who are getting that return prepared for a decedent. And then what that means is the mom or the dad or the brother or the sister would sign for the decedent. The head of household rules, again, California has their own rules. Filing status, we're going to talk about that shortly. And then when you hear that acronym RDP, that's a registered domestic partner. And so what that means is you might have someone who's registered with the state of California, and they have that same status as married filing joint. And that could be a male and a female. It could be two males. It could be two females. And again, that's a registered domestic partner. California has not yet updated this. I believe last year they used the qualifying surviving spouse. And so when you see the term qualifying widower, that means qualifying surviving spouse. And then we talked about a registered domestic partner. And then for California, there are many different types of income items, just like the federal government. And some items are taxed by the federal government and not taxed by the state, and then vice versa. We will talk about some of these today, but since we have the screen, we'll make this a little bit larger. We'll talk about this. And then Sean, I'm going to solicit input from one or more of our veteran preparers regarding in-home supportive services after I mention that. And so when you hear the term alimony, alimony is something that is ordered by a judicial official, i.e. a magistrate or a judge. And that would be for the state of California, that would be a state judge. And it has to be, let me restate that. When you're talking about alimony, again, it has to be ordered by a court. If you're making payments, and I've seen this before, if you're making voluntary payments to a spouse or a former spouse, and again, voluntary payments, what that means is you're a nice person, but it's not alimony. It has to be ordered, and that order is going to be written. So if you go to the clerk of the court, you can obtain that order to determine how much alimony has been ordered. And typically, alimony is paid to a former spouse, sometimes a current spouse. And the alimony rules for the state of California are different, and we're going to get into that. They're different than the federal rule. And what that means is California does not conform to the Tax Cuts and Jobs Act of 2017, that federal legislation. So that's an example of nonconformity. For capital gains and losses, we know that's populated on a Schedule D as in Delta. And when you're talking about the state of California, California still has short-term and long-term capital gains. However, on your California return, you're taxed at ordinary income rates, regardless if it's short or long term. And what that means is you don't have that preferential rate that appears on a federal return. Early distributions, you're going to see this a lot in the VITA program. And what that means is someone has some type of retirement plan, perhaps maybe a 401k or a 403b or a 414 or a 457. Those are all Internal Revenue Code sections. And so what that means is when you take an early distribution and you don't have one of those exceptions to an early distribution. So for example, let's say you've got a 401k, you take the distribution, you're 35 or 40, and you take the money and you go off on a long vacation and cruise. And you're not using that money for college, you're not using the money for catastrophic medical expenses, things like that. So that means that early distribution is going to be taxed by the federal government. You're going to pay a 10% penalty to the federal government, and then it's going to be taxed by the state of California, and then you're going to pay a 2.5% penalty to California. And as I've mentioned before, when you take early distributions, and I got the fact that people need money to live. I understand that. But when you take that early distribution, that's very expensive money. And then I think we have a financial planner. In fact, let me ask him, I forget who it is. Who's the financial planner, Sean?
That's me, Clayton.
Clayton. So Clayton, and I don't want to put you on the spot if you
Oh,
don't
go ahead, I
know,
love
then
it.
just say don't know. But can you talk to the class about the concept of losing opportunity, i.e., you pull money out of an investment, and the fact that you're losing opportunity or opportunity loss? Can you talk about that?
Opportunity cost, yeah. Inside of qualified accounts, 401ks, 457s like that, we get the power of compounding interest. And so if you take an early distribution, I tell my clients, don't do this. And if you're taking an early distribution, you're probably not going to be my client. Now, that's not always the case. But like Jerry was saying, it is extremely expensive. You face the 10% early withdrawal penalty and then ordinary income taxes on the money you're taking from your retirement accounts. So I essentially tell my client, if you take $100 out, you're going to pocket about 50. And then you lose all that compounding growth upon it. So is that essentially what you're looking for, Jerry?
Perfect. Perfect. And again, I got the fact, and I'll share a personal story. Years ago, my wife had a 401k, and she wanted to do some home improvement. And so, she's her own person. I said, well, sweetheart, if you take money out of your 401k, you're going to pay all that tax and all those penalties. And she looked at me, she goes, I don't care. Okay. So she took her early distribution. We paid a bunch of tax on it, and we dolled up the house. So again, some people just don't care. But if they're informed, then they may say, okay, I need money to live. I'll find another way to get some money to live in and not take that early distribution. And I will continue to save for retirement. And if you talk to a senior, and I talk to a lot of seniors, in fact, I talked to a guy last week. He's 81 years old, really smart guy, and he has nothing. He has no retirement. I think he has a Social Security check. And in his particular case, he saved cash in a bank account, so he's doing okay. But a lot of people don't. They cash things out, and they end up with their Social Security check, and that might be a tough way to live. Okay, gambling. I see this more and more at the VITA sites, and so when you win money at gambling, generally what happens is it's going to appear on your California return. Now we're going to talk about some of those exceptions, i.e., the California lottery, which is recorded on a federal return and not reported on a California return. That's one of those non-conforming things, if you will, or non-conformity. You're going to get a lot of this in VITA, and I am far from a gift and inheritance expert, but I do know this. If you receive a bona fide gift from an individual, which means you're not performing some type of work to get that money, it's your grandmother, she loves you, and she gives you $5 for Christmas. That would be a bona fide gift, and it doesn't go on a tax return, either federal or state. You're going to have inheritance of all different types. Someone may inherit a 401k. Someone may inherit a bank account. Someone may inherit a home or an apartment building. And so when you inherit, there's no such thing as tax on that inheritance. However, you have to consider, for example, if you inherit a 401k, which is a tax deferred program from your grandfather or grandmother who's passed, when you get the account, there's no tax on that. But when you start taking a distribution from that 401k account that you now own, then there's going to be a tax consequence. But a lot of people get twisted and turned. So what you can do is you can understand or educate yourself on the basics, and you can tell people a gift and inheritance is not a taxable event. And then, of course, as the example I just gave you, the 401k, that distribution is. If you inherit a house, that is not a taxable event. If you start renting that house out to tenants, then you have income, and that is a taxable event, both on your federal and state return. And so that's probably the differentiation. And again, I use the term taxpayer education or showing them the way. And there's no harm telling people this is the general rule. And then, of course, if you have a complicated situation, you can refer them out to not to an individual tax person, but to perhaps maybe a tax society where they can go on the website and they can choose their person. Or like I always tell people, I get a lot of my clients, my paying clients, is Jerry, what about this? And I tell them, and then there's different designations. But if you find yourself a certified financial planner, and again, there's different types of designations, they're worth their weight in gold. Kind of like a tow truck driver. When you're stuck, that tow truck driver is going to save your bacon. And if you can be the smartest person in the world, but it's like I'm not the smartest guy in the world, but I have a certified financial planner that helps me with my assets. And I think it's a great thing to do. And so no harm in foul making a recommendation. Hey, you got a complex situation, go find yourself someone who's trained and licensed and who works with these type of clients on a daily basis. Sale of a home, we see that from time to time in VITA. I probably see that maybe 2 or 3 times in a season for a particular site. We do, and Sean, you can back me up on this. If someone sells their home, we will help them at the VITA site. Is that the case?
Yeah, as long as they're, within our income limits.
Yeah, within the income limits. And when you're selling your home, this is typically what you're going to see. The taxpayer, if they're ready to go, they're going to bring in a settlement statement when they purchase that home, and they're going to bring in a settlement statement when they sold the home. And then, of course, one of the big thing for the sale of a home is determining what is called adjusted basis. And so what that means is sale of the home, let's say you bought it for $300,000 many years ago. And then you put in big ticket items known as capital expenditures, i.e. a swimming pool that didn't exist, a second story on your house that didn't exist, or maybe you have a room addition. You get a permit and the construction company comes out and they knock down some walls and build a room, another room in your house. And that cost all goes to what is called adjusted basis. And sometimes you're going to bump into people and they're not going to have these records. And so without those records, it's kind of difficult. In fact, it's impossible to prepare a correct sale of your home. Also for the sale of a home, and if I remember correctly, there's a franchise tax reform called a 593. And so what that means is sometimes there's withholding, state tax withholding for the sale of a personal residence. And if that's the case, your taxpayer should have that on the settlement statement. And that's something that you'll account for on your California return. All right. The 1099, what that means is it's an information return. There are many different types of 1099s. And sometimes the information return will evidence everything that's happened. Other times it'll evidence a portion of what happened. And so, for example, on a Schedule C, taxpayers will say, well, I got this 1099. Well, I say, okay, you got a 1099, but what we need to do, let's go back to the beginning and let's determine your gross receipts, all of the income that you received. And then all of that income appears on the Schedule C. And again, the 1099 may evidence some of the income. So we're looking for all of the gross receipts. Sean, at this point, can we go ahead and query the crowd here and see if anybody has prepared an in-home supported services return?
Yeah, sure. If you've done that, just take yourself off of mute and let Jerry know. Hmm.
You gonna check the chat, Sean?
Let me see chat.
And while you're finding a potential speaker, just real quick, you do see these in-home supportive services. So what that means is the state of California will, of course, you have to qualify. They will pay individuals to care for typically a loved one. And the first time I saw that, I'm thinking, well, that's kind of interesting. And so a W-2 will be issued, and if the taxpayer qualifies, that income is not taxable both on the federal and the state side of the house. And so it's called IHSS, in-home supportive services. Again, typically you're caring for a loved one, you've applied and you qualify, and the state of California gives you money, pays you money to watch that loved one. And I'm thinking probably the legislative intent behind that is if you have someone who is mentally challenged or physically challenged, and they're in state care, that's a very expensive thing. So the state says, hey, we have loved ones who can watch them, and we'll pay them a modest amount. And again, it's a lot cheaper than the state care. That's my understanding of IHSS, and you'll see that once in a while. Did you find a
Jerry,
candidate?
This is Bruce. I've prepared them before in home support
Okay.
services.
And Barbara Harris is saying she's done that as well.
And I think,
All right,
Jerry, the tricky thing on those is, I'd have to look it up to make sure, but you wouldn't be taxable, but for the purposes of like the earned income tax credit, you can load it back in. So it's among the things to do. That's a tricky one, I think, to make sure that you do that one right.
Jerry,
Yeah, and
Yeah.
I took myself off mute, so I don't know if you can even hear me. We call them Medicare waivers. We see a lot of them. It's my understanding that if the person that you're caring for lives in the same house as you, it is not considered taxable income. It is, and you do qualify for earned income credit. However, we see a lot of people who receive these, we call them Medicare waiver W-2s, but they are caring for relatives that do not live with them. And it's our understanding, or this is the way we've been treating this, if they don't live with you, it's taxable.
That's my same understanding also.
Yeah.
Okay, thank you.
always
Yeah,
have-
and
I
there
always
was an IRS notice that came out about 9 years ago. And if I remember correctly, it was IRS notice 2014-7, which talked about these in-home supportive services and what is taxed and what is not taxed. And the rules are very, very specific. And so that's something that does appear in, well, certainly, obviously, the site map. So if you have a taxpayer that comes in with that, you can go to this portion, because this deals with the California taxability or non-taxability of that payment made, again, to an individual typically caring for a loved one. Okay.
And
All right, thank you, Barbara. Appreciate that.
the first clue that you have that you're dealing with this situation is the W-2 comes from West Sacramento. So anytime you see a West Sacramento W-2 as the employer, then you should be starting to ask questions about what the nature of the work is and whether they live together.
Yeah, that's a good
And
point.
the W-2 social security number is the EIN number of the person they're taking care of.
Yeah, and Scott, I think we used to call them the Roseville W-2s,
Yes.
and now they switched to West Sacramento.
Yeah,
Yeah.
they moved a couple years ago to West Sacramento.
Okay.
Right, we used to call them the Roseville W-2s.
Yeah. And all doable, because again, the material is there, both the federal material and the state material, to determine the taxability of that IHSS payment. A couple of things, and we'll get into this in a little bit of detail. Social Security, when you're talking about the federal government, sometimes a portion of their Social Security payment is taxable. When you're talking about the state of California, They do not conform to that, and so California does not tax any Social Security benefits. And then unemployment, we've talked about that before. That was a big issue back in 2020 and 2021 with COVID. That is not a big issue now. So again, when you have an unemployment benefits, it'll be evidenced by a 1099 that'll be issued by the state, 1099-G. Those are governmental payments. And all you need to do is enter that data into the software, and then the state of California will not tax unemployment benefits. And then, of course, we talked about wages. Typically in the VITA program, when someone has a W-2, it's going to be a taxable event. There are exceptions, and like I've mentioned in one of my classes, there are special populations and certain populations who receive a W-2. They're a wage earner. None of their wages are included in gross income. But generally in the VITA site, it's going to be a fully taxable event. And I'll mention this when you talk about residency. I actually did a research project this past summer about California part year and non-resident taxpayers. We don't do that in VITA. Very complex rules. We only work with residents. We only do the Form 540. And so typically your VITA client is going to be a resident in California for the whole year. And that's what we're working with. Okay, a couple other things. You will see this from time to time. These are called voluntary contributions. And so a taxpayer comes in and they're aware of certain types of funds that collect money for good purposes. And what the taxpayer can do right on their California return, they can make donations. So let's say they got a refund coming to them of $1,000. And they make a determination that they've looked at some of these funds and they want to essentially donate all of those refund monies to various funds. And so you can see right here, you start off with the Alzheimer's and Dementia Fund, and it goes all the way down to suicide prevention. And so these are essentially funds that have been vetted by the state, therefore a good purpose. And a lot of times taxpayers say, yeah, I'll go ahead and donate some or all of my refund check to one or all of these various funds. So you will see that from time to time. Okay, other things when you're talking about filing a return. When you file a return, we do electronic filing at our VITA site. And that's typically not an issue for our clients. Some individuals want a paper return. And it's not like I sit there and have a long debate with them. I say, well, filing a return electronic is safe and it's quick. And if the taxpayer says, I don't want it, then what I do at my site, and Sean, I think you're going to do the same thing. I hit print and say, there you go. There's your return. Show them the way. So you want to make sure you give them the address to the state of California where they will paper file the return. And then on their paper filed return, they can still ask for a direct deposit or make payment of the tax at direct debit. But most of the people that I bump into, once you tell them, hey, it's quicker and it's safer, they'll say, okay, sign me up for electronic filing. And then what we do is we have a form, both a federal form and a state form, the 8879, and that would be for electronic filing. And I've had a couple individuals, and sometimes they're youngsters and sometimes they're not. And we just have a quick conversation. And a lot of them are under the impression that they don't want to give the state of California or the federal government their account information. And I tell them, what I know about bank accounts is once you sign up, that data is available or provided to the federal government, the state government. So they already know about your account, especially if you are receiving interest from the bank. And so, and then most people say, okay, I got it. Go ahead and sign me up for electronic filing. And then let me get over here. Make myself dizzy. So when to file, this is something that every year, typically you're looking at a filing deadline, both federal and state, because the state piggybacks on that for individual returns, and that would be April 15th. That's the general rule. Now, there are exceptions. Last tax year, the 2022 tax year, if I remember, I think we went all the way to November 16th. And before that, it was October. And I think a couple, 2 or 3 years ago, we went all the way to like July. But those notices will come out. And when those notices come out where the season has been extended, i.e. to file a return, then your site coordinator will obtain that information and then share that with the people, i.e. the volunteers. And then some sites then will extend their dates. If you remember St. Killian last season, we went into May. And I think we had a couple, 2 or 3 additional dates where we prepared returns. All right. And then if you look over to the left-hand side, sometimes you want to get a form or you want to review a form. If you want to review the form electronically, then you can go to the sitemap. But if you actually want to get a hard copy form, and let's say it's not loaded up in the franchise tax board system, you can contact the franchise tax board, typically electronically via email. I've done that dozens and dozens of times. I'm asking for something and I'll get an email the next day or maybe later on that afternoon. And the franchise tax would say, here's the form that you've requested. And typically it would be current year. I've also called, and that's another way to get forms. But most of these forms, certainly for the past tax year, they're going to be already populated on the franchise tax board website. But if you need a form, again, you can go to the website or you can call or shoot them an email. And then I think we're about done here. So you can see 2023 limited instructions, and it goes back into previous years. This is something that you'll see from time to time. We have the software, and if I remember correctly, Sean, I think our software goes back in the VITA program. I think it goes back either 4 or 5 years. Do you recall?
We have returns going back 5 years, but we're only able to e-file going back 2 years.
Okay. And so when you're looking for franchise tax board information, let's say you got someone comes in and they haven't filed for maybe the last 3 or 4 years. If you're, and it's important to make sure your site coordinator knows about this, because you don't want to be working on a tax year 2017 return and going to the paper file, but let them know that you want to prepare a return, and your coordinator will say yay or nay. And then, yes, sometimes you cannot electronically file. Typically at my site, we go back maybe a couple years, and finding these old booklets and these old forms, you can do it in the software, or you can request an item to be sent to you by the state of California. All right, Sean, I think that takes the rest of the stuff is like business stuff. And so I'm going to go to the top here, entertain questions, and then we'll take a break.
Jerry, there's one question in the chat asking about, are the schedules currently available for the 2023 tax year?
Yeah, I would say no. I searched on the franchise tax board website trying to find 2023, and I was unsuccessful.
Yeah, and usually the California part of the tax layer is the last thing that becomes available.
And yeah, and that's a good point. When you're ready to go through your training in January, those forms should be published, and the California portion of the tax layer should be published, ready to go. And as we mentioned before, sometimes you're going to be working with the software early on, and there may be software updates that are forthcoming. And that's happened before. And so you just follow the instructions put out by the IRS / the FTB to address those changes, i.e. updating software. And the last thing you're going to find in software is perfection, although they do a pretty good job. I've worked with TaxSlayer. I've worked with TaxWise many years ago. I've worked with Drake, but I don't think I remember any issues with Drake. But sometimes the software is not properly programmed, whatever the term is. But again, we'll be notified if there is an issue. And we've had issues in the past. And so it's kind of like the commercial. You got to roll with the punches. So, but again, there's notification that'll come out from Franchise Tax Board, IRS, if there's a change in the software, and then what needs to be done, what action needs to be taken. All right, Sean, any more questions? Otherwise, we'll go to our break.
There's just one more comment in the chat about in-home care, and it says, well, I guess it's a question. If the person who's a live-in caregiver is being paid by a long-term care life insurance company instead of the government, is that taxable? I think we're getting in the weeds there.
Yeah, I don't think I would tackle that if whoever asked that question, if you've got a detailed fact pattern, which means I do not need a name or a social security number, you can email that to Sean and I, and then what I'll do is I'll tackle it and I'll give you a chapter and verse next week.
Okay. Time for a break then.
All right. Okay, I've got 10:03. Let's come back at 10:13.
Jerry,
All
this
All right, Sean, we are back. It's 10:13, and on your screen, it talks about the practice lab when you want to certify for the tax year 2023. And as mentioned earlier, IRS, the contractor, they're still working on the 2023 certification, and so you'll have to wait a few days. Sean, what's the due date for the certification for the St. Killian's volunteers?
We want everybody certified by January 15th, but we're starting our tax season January 27th, but we're going to be having a meeting with all the volunteers the week before to verify identifications. And, we're really wanting everybody to have their certifications in by that meeting.
By the 15th of January. Okay. And that's a good rule of thumb. And as we mentioned before, if you're new to VITA, or if you've got a couple years under your belt, it's not required, but it's probably a good idea to take that basic module first for the certification, and then prepare your advanced certification or certify on your advanced module. All right. Okay. And we froze already, so let's unfreeze this and go back to our PowerPoint. Okay, so real quick, when you're looking at that VITA manual from the state of California, it has a lot of information. It talks about 2023 tax year. And one item it talks about the filing status, the personal exemption credits, and the dependent exemption credit. And this all appears on the form 540. And so you can see, Sean, looks like a toolbar upgrade. Let's see if can you see that on the screen?
No, I do not. We just see your PowerPoint.
Okay, and that's just me then. All right. Okay, so then moving on, when you're talking about your filing status, this is what you're allowed as far as the standard deduction. And so the standard deduction simply means generally our taxpayers are going to take the standard deduction or the itemized deduction, whichever is greater. And so typically this is not a discussion that we're having with the taxpayers. We obtain their data. We end up finding out that their standard deduction is going to be greater than their California itemized deductions. And as you can see right here, this changes every year. And so for the standard deduction for married filing joint would be almost that $11,000 amount. Now, when you're talking about the qualified surviving spouse, that would be the same as a head of household, 10,726. This is populated automatically in the software. All you need to do is indicate the filing status. And typically the filing status for state of California is typically going to be the same as the federal government. That usually is not an issue. Okay. All right, and then of course your personal exemptions, this is something that also changes year to year, a small increase. And these personal exemptions then would be essentially a dollar for dollar reduction of the tax, which we're going to show you later on in this Zoom session. And then if you have dependents, there's an exemption credit that you're allowed, and that's $446 per person. And so again, this is all pretty much automatic. You don't have to think about it. But again, when you look at that franchise tax board VITA manual, this will be reflected in there.
Hey, Jerry,
Yes.
it looks like instead of a cursor, you have a pen. I don't know. If
Okay,
did
you
that
do
on
see
purpose.
something. Yeah, I'm trying to make that go away, and I'm not smart enough. Let's see.
Oh,
Did I
there it
make
went
it
away.
go away?
Went away. Yeah.
All right. Well, maybe I am smart enough every once in a while. Okay, so let's go ahead and go back and can't explain it, but apparently it freezes a lot. Okay, let's talk about that California healthcare mandate. And so this is a law that passed back in, I think it passed in 2019. It was effective January 1st, i.e. tax year 2020. And so this deals with that affordable healthcare, the minimum essential healthcare coverage. So California said everybody's got to have it unless they qualify for an exemption. And so if you have a low income taxpayer who cannot afford the insurance, the health insurance, that most likely will be an exemption. And if they do not have health insurance and they cannot obtain an exemption, that's where that California individual share responsibility penalty kicks in. I've seen this on VITA returns before. And so you may end up seeing it. When I see it, what we try to do is we try to find the exemption for the VITA client. And let's see, what else do we need to know about this? Yes, when you're talking about covered California, what that means is you're purchasing health insurance, and that would be for you, your spouse, typically the kids that are at home, and you are receiving some type of taxpayer subsidy. And so that means your insurance premiums are lower as opposed to picking up the phone and calling an insurance broker and paying a lot of money for your health insurance. And then this is something that is non-negotiable if you're talking about covered California. When someone comes in and they say, I'm in covered California, that means they should have received a Form 1095 Alpha, which is an IRS form. And it's going to show the amount of their subsidy, the amount of the premiums that were paid. And so again, this is something that's non-negotiable. If a taxpayer comes in and they go, I don't have the 1095A, then we say, okay, then go back to covered California. Maybe you have to talk to a navigator. The term navigator, that would be someone who's trained and they assist individuals getting into covered California, the website. And then, of course, another takeaway for covered California is if you're in covered California and something has changed in your life, i.e. you received a significant pay increase, or you've got a new baby, or a baby grew up and moved out, or you have moved your residence, or you've gotten divorced, or you've gotten married, it behooves the covered California client to go back into covered California and update that data. Because what happens is you do not want to receive too much of a subsidy. Sometimes you're going to get too little of a subsidy, and then that's when you're going to get an additional amount back, which we're going to talk about. Or if you receive too much of a subsidy, then you've got to pay it back. And that's a scary proposition for moderate and low income taxpayers. And so these are typically the forms you're going to see when you're talking about health insurance. You've got health coverage from an employer or you're in the marketplace. And when you're in the marketplace, again, you've got the federal exchange, and that covers a lot of states. And then you've got certain individual states like California, they've got the equivalent, and that's called Covered California. Sean, this is probably a good point, a good time to ask someone in the group if they want to talk about it, if they are in Covered California, and what their experience has been.
Well, if somebody else is in Covered California, they can speak, but I actually use Covered California to purchase
Okay, great.
insurance.
Did you want to share?
Sure. I purchased insurance for my adult dependent child because she doesn't work, so she can't get it through her employer. And it's just a pretty easy place to get decent quality insurance at a reasonable price. I do not apply for a subsidy. California is very generous, so they give me $1 off every month anyways. They give everyone a $1 subsidy whether you ask for it or not. But I know I wouldn't qualify for a subsidy. But
All
I
right,
get
well,
the 1095A every year and then fill out all the paperwork.
Okay. All right. So again, a non-negotiable when they're in Covered California, we need that 1095A because it's called a reconciliation. It's a requirement. It's also a requirement to file a return if you have a 1095A. And usually that's not a big issue. Sometimes people lose documents, misplaced documents. And so again, you can still, this is what we do at our VITA site. We prepare as much of the return as we can. And then we ask them, when can you get this 1095A? And typically they'll say, hey, I can go home. I'll be back in 15 minutes. Great. We'll still be open. We'll help you out. Okay, when you're talking about that shared responsibility penalty, if you have full year health coverage, then you're good to go. There's not an issue. But if you don't have full year health coverage, then you're going to indicate in the software that maybe you've got part year or maybe you've got no health coverage. And if you don't have no health coverage, then you have to find one of those exemptions for California. And that's what we do in our VITA site. We try to help the taxpayer as much as we can. We'll do that additional probing questions to determine if we can find an exemption. So here are some exemptions that can be claimed on a California tax return. You've got individuals who can't afford it. You've got in fact, in some examples, I don't think I've ever prepared a return for a minister. I prepared a return for a retired minister, but again, if you're a member of what is called a healthcare sharing ministry, then that's something you get an exemption. We do have individuals who are Native Americans, and they can find an exemption. I've dealt with a lot of incarcerated individuals. And when you're incarcerated, a lot of people think that the world stops. Well, part of the world stops for you, but you still have a requirement. And that requirement is you might have to file a return. And so I've worked with people who are still incarcerated. They reach out, usually through an intermediary, and we help them file their return.
Hey, Jerry.
And so again, this is your laundry list of exemptions that you'd be working with.
Jerry, can I clarify one thing? On the
Sure.
on the minister thing, the health care sharing ministry, that's not applying to ministers. That is you'll sometimes hear their commercials on the radio. There's these nonprofit organizations that provide a way to pay for healthcare, but they're not insurance companies, and they target people with certain religious beliefs, and they will not pay for services that those people feel violate their religious beliefs. So it's a different kind of getting health coverage.
Okay, good point. Okay, again, all of this is found in that VITA manual for the state of California. All right, moving on. Okay, so a little bit more, and again, you'll see this from time to time, not that often, but when you see it, then this is how you can explain it to your VITA client. And so again, if you don't have insurance, you cannot find an exemption. There is a penalty, and that flat amount is $900 per adult. So this starts to add up, and $450 per child. That's the minimum, if you will. And so again, the takeaway, I think, is trying to find an exemption. And a lot of times it would be, hey, the taxpayer can't afford it. And you indicate that in the software, and then you move on and the penalty doesn't pop up. And then you can see at the very bottom, if you do have to pay that shared responsibility tax, that penalty, the California Form 3853 is the one that needs to be populated in the software. Okay, the filing due date, as of now, it's going to be April 15th, 2024. And so that's what we're going with. Now, of course, if there is an extension, it could be natural disaster or whatever. I think for COVID, that came out, and we shared that with the volunteers. But again, April 15th. And then typically what happens is your last date. In fact, Sean, do you have a last date for the VITA site?
Yes, Jerry. So we will, our last full day is going to be April 6th, which is a Saturday. And then we will be open April 13th, but only for people who are picking up returns that were dropped off the week before.
Okay, April 13th for pickup. Okay, gotcha. And then certain VITA sites will operate close to the 15th. Some of them will actually operate on the 15th. But the key is for the electronic return originator is to get those returns filed as soon as possible. But again, that's for California and for the federal government, that's the date as of right now. Okay, and then filing status. This is usually not an issue because generally filing status that we utilize on a federal return, it's going to be the same for California. And these are the statuses for the new volunteers. Typically, we work with single, head of household, and married filing joint. That's usually what you see at the VITA site. We don't prepare separate returns. We talked about that before. Non-negotiable. If someone says, I want to file separately from my spouse, then you could acknowledge that and say, I understand, but we don't prepare those returns. So you just don't make an exception for that. And of course, that begs the question, where do we go? And I always tell people you can go out in town and find yourself a paid practitioner. And you can go to a website for the Enrolled Agent Society for California, California Society of Tax Consultants. But again, we won't prepare those returns. And then the qualifying surviving spouse, the old term for that was qualifying widower. That has changed. And RDP, again, is a registered domestic. And for head of household, you will have to take another step. You've got to populate that franchise tax board form 3532. That's got to be completed when you are a head of household filer. And typically for head of household, generally what you're going to see is you're going to see individuals who have a minor child at home. The parent has a home or an apartment, and what they're doing, they're paying, typically they're paying the rent and the mortgage. That's usually what you see for head of household. And then as we talked about for the federal filing, which will roll over to the state filing, if you have someone who's left the house, i.e. let's say you've got a husband and he decides I've had enough and packs his bags and leaves, and he's gone the last 6 months of the year. What that means is the individual remaining in the house is considered unmarried for tax purposes. And sometimes you'll see that in the tax world for tax purposes, and that's the terminology. And this probably also is a good point when you're to mention this when you're working with a taxpayer who has minor children, you're going to have to obtain that Social Security card. Usually, mom or dad, they've got access to the Social Security card, and they'll bring that to the VITA site. We want Social Security cards because we don't want transposition errors, because if you have a transposition error in a Social Security number, that means the return will electronically reject. And then that means there's action that needs to be taken on the VITA site part. And that's additional time and energy that's expended. So we're looking for the Social Security card. And I don't know the local Social Security office, but you can Google it. I think there's one, Sean, if I remember correctly, I think there's one in either Mission Viejo or Santa Ana.
I believe there's one in Lake Forest, but I'm not 100% sure.
Lake Forest.
You-
And if you've never gone to a Social Security office, and I have for myself one time, and I went on behalf of my mother-in-law one time, you go in there, you make an appointment, and you say, this is the issue. If it's replacing a Social Security card, they're not going to hit print and give you a card in the next 3 minutes. You simply request it, and usually it's a few weeks to get a replacement for a Social Security card. Okay, now we're going to show you page 23 of the manual for the state of California. And as we've talked, and this is for the newer folks, VITA, of course, is the Volunteer Income Tax Assistance. TCE is tax counseling for the elderly. It is a program. And then also you have the AERP program. And so you got these 3 programs, and they all do good work. And it's been my experience with AERP, they got some really well-trained volunteers. And so sometimes we've actually had clients leave the VITA site and go to an AERP site. And so again, and I think we've got a couple AERP folks on the call here. And if they wanted to say something about AERP, please do so. I think Barb is on the call. Okay, all right, then I'll leave the plug in.
I'll just
All right,
say
we'll make this-
one of the reasons people will leave is because the the income limits are different for AARP than they are for VITA.
Yeah. And again, it's just been my experience. AERP, very well trained. I think they still call them counselors, and they're worth their weight in gold, because it just, when you have someone who's well trained and well experienced, then things usually go pretty smooth at the tax site. All right, I'm trying to make this larger, Sean, and this is from the California VITA manual. And this talks about filing requirements. Let's see if I can find that. All right, well, that's as good as it's going to get. So filing requirements, it depends on filing status. It also talks about how much gross income they have to have. AGI, this is for the state of California. And usually what happens is, I'm not going to memorize this. This is for reference only. When somebody comes to the VITA site, they're there to get a return done. And if they ask me, Jerry, do I have a filing requirement? I'll say, hold on a second. And I'll look up the federal rules, and I'll look up the state rules, and I'll say either yay or nay. And then at that point, if the taxpayer decides, hey, I want to file a return, you can do so. But if you do not have a filing requirement and there's no credits involved, then you can walk out, and no harm, no foul. There are some individuals, and it's been my experience, mostly seniors, they're used to filing return. They've been doing it for 40 or 50 years. And so they'll just look at you and say, whatever it is, I want to file a return. And again, as we talked about, we will file a return, at least at my site. And I think, Sean, you mentioned returns will be filed at St. Killian's if someone wants a return filed.
Oh yeah, and we'll encourage it, because even if you don't have a filing requirement, this is going to provide you some level of protection against somebody doing identity theft and using your social security number to do weird things.
Yeah, so no harm, no foul. And again, when someone comes in, we're gonna, usually it's first come, first serve. And we again, at my site, we prepare these returns. A lot of individuals just have Social Security. And I think we talked about this before with Social Security. Then if there's no tax on that, usually we put $1 in gross income or other income, so the return will electronically file. I think that's still the issue there. Okay, so this is page 23 of the Franchise Tax Board VITA manual, which again talks about filing requirements and the amount of gross income that someone has to have depending on their filing status. And so, for example, if you've got a youngster, someone who's under age 65, and they have no dependents, and their gross income is $21,561, they've got a filing requirement. All right, and we'll go to the bottom of this to show you all of the various filing statuses. And qualifying surviving spouse, again, that's the one that took over. That term now is used instead of qualifying widower. All right. I think that's about all we need to show here. So what we'll do is we'll go back to our PowerPoint. And if you've had an opportunity to use this manual in previous years, state of California does a really good job updating this manual. And it's a go-to document for California tax preparation. Okay, let's look at some other items of income. And a lot of these things you probably know if you've been a volunteer before. If you're new or newer, again, we've talked about the term conformity and nonconformity. Or stated differently, the federal government will tax certain things and the state of California does not, and of course, vice versa. So we'll talk about certain things here. So when you're talking about savings bonds, which a lot of young adults probably have never even heard of. I teach a lot of young adults accounting and taxation, and it just doesn't resonate with them. But savings bonds, you can buy them on the website. I think some employers still help out. You can purchase them with your wages, treasury bills, and other bonds of the United States. So interest income on that is not taxed by the state of California. Here's something that a lot of people will get a state tax refund, and they're concerned about the treatment of that. So on your federal return, if you receive a state income tax refund and you did not itemize on your federal return in the previous year, you did not take what is called a tax benefit, which means your state tax refund is not taxed on your federal return. And of course, doesn't matter what happens on your state return, those state income tax refunds are not taxed. And then back to your federal return, if you've taken a tax benefit, which means you deducted your California tax on your Schedule A as an alpha, then you may have to report some or all of your state income tax return on your federal return for the current year. We've already talked about unemployment compensation. That's not taxed by the state of California. Social Security benefits are not taxed. And then when you're talking about Social Security benefits, the SSA 1099, that's going to be issued to the recipient. And on the SSA 1099, it will also have information pertaining to the Medicare premiums paid by the taxpayer. And then sometimes you have in fact, great example at our site last year, we had, I think, 2 or 3 recipients of Social Security. They applied for Social Security, and it took a couple years for their benefits to be paid. So they received lump sum Social Security. So in your software, you want to be able to jump in there, talk to your senior folks at the site, talk to your site coordinator on how to treat a lump sum benefit for federal tax purposes. Again, on the state of California, it's not taxed. And then I don't see this often, but if you have someone who works for a railway or railroad, they're not going to get Social Security benefits. They're going to get what are called Tier 1 and Tier 2 benefits, which are the equivalent of Social Security. And this is something you'll see again and again. Everybody thinks that, I shouldn't say everybody, there are some people that think that everybody's entitled to Social Security. Well, that's not the case. So one example is my former boss, who was a federal employee for 40 years, never certified, never was qualified for Social Security. And to this day, I don't think ever gets any Social Security benefits because my boss got the federal, what is called the civil service retirement. So there are certain professions where the taxpayer does not get Social Security benefits. Another example is like I teach at a couple of California colleges. I don't pay into Social Security. I pay into to Medicare. That's a different animal, if you will. But you've got these school teachers or individuals who taught at a college, and they've never paid a penny into what we call FICA, the Federal Insurance Contribution Act, which means they're most likely not going to get Social Security. So that's going to happen from time to time. So simply because you're 65 doesn't mean you're going to get Social Security benefits. And then another thing that you'll see at the VITA site, you'll see individuals, I think I've seen them as young as 56, where they are receiving Social Security benefits. And people kind of scratch their head and say, how is that? Well, if you're a federal employee and you retire, again, I think it's about 56 and change, you may be eligible for essentially supplemental security, Social Security benefits. And so you'll see people of that age. And then you see other people in their late 60s, they're not getting benefits. They're waiting till they're maybe 70 because the benefits will be larger per month. And so again, you'll just see different things, but you're looking for that SSA 1099, and again, not taxed by the state of California. And then for California lottery winnings, some people think it's big bucks, and some people thinks it's a little bit less. If you have someone who's won the California lottery, and there are different names that we're going to talk about, that is not taxed by the state of California, taxed by the federal government. If you win $1 in some type of lottery or some type of gaming activity, gambling activity, that dollar is reported on your federal return. And for California, it's your lottery winnings are not taxed. And you probably remember that story that came out probably about 4 or 5 months ago, where someone won, I think it was $1 billion with a B, and it had to do with the California lottery. So taxed by the federal government, not taxed by the state of California. And then again, this publication 1001, if you've never jumped into that, take a look at it. It talks about the various adjustments, what is taxed, what is not taxed. And this is a very informative publication. I actually, in my tax practice, there's a lot of references that I go to, and this is one of the references, the 1001. Okay, let's talk about alimony. And when I first started VITA, I never saw alimony. VITA clients, we just didn't see them. And now I see more and more of that. And so again, what we want to do is we want to be able to define what alimony is. It is an order by a court official, i.e. typically a judge, who has the jurisdiction to issue that order. And this is typically payments made to a former spouse, in some cases, a current spouse. And so all you have to do is differentiate between the federal and the state rules. And then you also have to differentiate between the time frame. And so what we're going to do, we're going to look at California. If you receive alimony, you got to report it on your California return. And if you're paying alimony and you want to take a deduction for it, then you're gonna populate that on your California return. And the one thing you're going to do when someone has paid alimony, you're going to obtain the name of the former spouse and the Social Security number. You got to have that. And then when you're talking about conformity, California doesn't conform to the Tax Cuts and Jobs Act. And so what that means is you got to report the alimony payment you receive, and you can take a deduction if you want. On your federal return, if you're talking about those older divorces, and this is before, it says on or before December 31st, the older divorces, if you will, you had to report your alimony that you received. And I actually saw this at St. Killian's a couple of years ago, where a taxpayer came in, and I think she had $20,000 or $30,000 of alimony. It was a surprise to her that she had to, this is an older divorce, that she had to report that alimony. And then, of course, you were allowed under those older divorces to take a deduction, or an adjustment, I should say, the amount that you paid that former spouse. And again, California didn't comply with that. You just got to go back to the rules. California says report alimony, and if you paid alimony, you can take a deduction. And then for your newer divorces, if you will, this is after on or before January 1st. The new rules are on your federal return, you don't report alimony received, and you're not going to be able to take a deduction. And California, again, we have to go back to the rules. They just don't conform. You got to report the alimony. And then sometimes people will ask you, well, why is it on an older divorce I have to report alimony, and on the newer divorce we don't? And the answer to that is very easy. You've got you have the Congress, they've passed a tax provision signed by the president, and that's just the way it is. And I don't know how else to put it. You got changes in the tax law, and when you have changes in the tax law, you have to adhere to those rules. Just like when you have changes to the California Vehicle Code, and now you can go ahead and drive 95 miles on the freeway. That's what it is. So, but I get that all the time. Why is this, Jerry? And I'm not trying to be flippant. I just tell them, hey, the law's changed, and so you happen to fall under this. And then usually people, maybe they're not happy about it, but they understand. Going back to that taxpayer education, because there's just a lot to know in the federal and the state side of the house when it comes to tax. You'll never know all the rules, but you want to be familiar with many of those rules. Any questions about alimony?
Hey, Jerry, I always think about why the transition other than Congress doing it. It always makes sense to me that it's done this way because you figured that there was a settlement, it was a divorce settlement, and the divorce settlement baked in the assumption of who's paying the income and who's getting the deductions. And suddenly you change the rules and you create a winner or a loser if you suddenly change the rules on it. So it's like, okay, we're going to keep the grandfather rules the same for these old ones just to maintain the kind of the equity that was negotiated. But I don't know if that's why it makes sense to me, but
yeah, it kind of reminds me of a story. If you want fairness, you're not going to find it in state and federal tax law. If you want fair, then you'd go to the Orange County Fair. That's about as fair as you're going to get.
You said that sometimes alimony is paid for an existing spouse.
Yes.
We wouldn't deal with that though, because they'd typically be filing separately then if they're going to be putting that in.
It might be legally considered.
If you're filing a separate return, I mean, you see all sorts of things, but if you're filing separate, again, we just go and we go to the rule. We can't help you if you're filing separate return. And you're going to get that time and time again. You're going to have people, they're going to look at you with those sad eyes. They're going to go ahead and plead. And you just have to say, we can't help you. Now, what that means is you can go out in town and a lot of these separate returns, your practitioners, they're not going to be charging thousands and thousands of dollars. Some cases, maybe a couple, 200 or 300, but yeah, they got to go out in town. We just can't help married filing separate taxpayers.
Right, but Jerry, it's also very likely that if somebody's paying alimony, then they're separated and might qualify as not married for tax purposes, even though they're still legal.
Yeah, the general rule, I think what you're going to see when someone pays alimony, the general rule is going to be a divorced spouse. That's a general rule. But again, sometimes you might have a current spouse.
If they're not divorced, then it's not considered alimony. They have to be divorced or have a separation instrument showing that they're divorced for it to be considered alimony.
Well, I would disagree with you. I've read the legislation, the federal legislation, and in some cases, a current spouse, i.e. you're still married, and if you're paying alimony, that could be the case.
Okay.
But as you pointed out.
a judge would have to deem it. It'd have to be illegal. You can't just do a side deal, right?
Yeah, because I mean, if you say emphatically, like I go back to the example I give, if you want to be an attorney, a licensed attorney in the state of California, you got to graduate from law school. And you know something, that's not the case in California. You don't have to graduate from college. You don't have to graduate from law school. But what you have to do, and this is the exception, you've got to study under an attorney or attorneys, and then you have to pass the bar examination, and then you can be a licensed attorney. So there's always exceptions to things, just like the W-2 exception. There are certain individuals who receive wages and they're issued a W-2, and they do not have to report their W-2 wages on a federal tax return. So there's always exceptions, always. Okay, let's jump to gambling winnings. This is the W-2G. And I'm not a big gambler. I go to Vegas maybe once, maybe twice a year. But what happens is there are certain games where a W-2G will be issued. And for California lottery winnings, there's different names for it: Powerball, Mega Millions, Super Lotto. Plain and simple, they're not taxed by the state of California. They are not. And so what that means is you're going to report that on your federal return, and then you have to enter the California return and enter the amount of winnings that are not subject to tax. And that's one of those tabs you'll see in the tax layer program. Other things, gambling losses. It says here gambling losses are not deductible for California. And so gambling losses and the rule for the federal side of the house is you're going to report your winnings, you're going to report your losses on your schedule A as an alpha, and your losses are allowed up to your winnings. And some people, they'll win something in some type of gaming, and they're not going to be issued a information return, i.e. a 1099 or a W-2G. And of course, people say, well, all right, well, why is that? Well, it's real simple. There are certain games, i.e. I'm not a roulette guy, I'm a craps guy. So when I go to the craps table and I win money, which doesn't happen very often, they give me those little plastic chips. I walk over to the cash cage, I redeem them for currency, and they don't issue a 1099 or a W-2G. So there's certain games you're going to get a W-2G, and other games you're just going to get green dollar bills when you cash in your chips. But again, California lottery, not subject to California taxation. Okay, and then miscellaneous itemized deductions. You might remember, if you've been in the tax world for a few years, back about 4 or 5 years ago, the Tax Cuts and Jobs Act was passed. And what that did on the federal side of the house, it eliminated or suspended, I should say, the miscellaneous itemized deductions. And so the term suspended means if Congress doesn't take any action, then they're going to be resurrected. But for the state of California, it says right here, there are certain expenses that you're allowed. So we're going to show you later on where someone has paid some type of tax prep fee, not allowed on the federal return, but allowed on the itemized deductions for California. So you're going to see that.
We have a question from the chat, Jerry.
Go ahead.
If the wife does not work for 40 quarters, but is filing a joint return with her husband, who is eligible for both Medicare and SSA, is the wife also qualified for Medicare?
Ooh, I am far from a Medicare expert. I've read a little bit about it. So the short answer is I don't know.
Me too.
But I do know this: if you're eligible for Social Security, then you want to contact Social Security Administration, and they have. In fact, I'm seeing the commercials now, and then you can dig down and you can find out if you qualified. And if you are, and you want to sign up for it, sign up for it. What about our financial planner? Clayton, do you know anything about Medicare?
I do. I was waiting for somebody to ask me about it. Yeah. If one spouse qualifies, you can do a surviving or a married spouse election in your Medicare. A couple stipulations go on that. It's out of the scope of what we're going to be talking about here. So whoever wrote that question, if you want to reach out to me directly, feel free to do so, and I'll help you with that.
Okay. Yeah. A lot of things when it comes to Medicare is because I'm not on it and I've done little to no research. Yeah, it's a whole different world.
Think about it like work insurance. Like if you're working and your spouse is not working, you can have, your spouse and your kids on your insurance plan, kind of similar like that, although kids aren't on Medicare. But happy to talk to that individual directly.
Okay, very good. All right. Okay, so let's talk about some of the California credits. And when you're talking about California, they've got credits that you'll see on a regular basis at the VITA site, and they include that earned income tax credit. You're going to see that a lot for California. But for California, that would include wage earners, and it would also include individuals who are self-employed. And then if you come up to this term, you're going to see the word earned. And so when you're talking about earned income, again, W-2, self-employment, it doesn't account for unearned income. Unearned income, typically called portfolio income, would be interest income that you receive or dividend income that you receive. or capital gains. So that's unearned income. The young child tax credit, that's going to be for individuals. We'll go through each one of these. We give you a quick intro here. That's going to be for those kids under 6, the foster youth. You'll see, in fact, I went to a foster youth, I guess you'd call it, home. I couldn't believe the number of foster youth that were being taken care of at this home. And these were individuals who I think they were better part of 16 and 17 years of age. They never got adopted, and so they lived in a group home. And of course, it was administered by individuals who had certifications. The non-refundable renter's credit, this is something you'll see a lot of. That simply means an individual is renting a home or an apartment, and it has to be a California-based property, and they have to be renting for over half a year. So we'll get into the rules there. We've already talked about the dependent exemption credit. The child and dependent care expense credit, this is essentially mirrored on the federal rules, but again, different rules for California and state. So typically when you're getting the California dependent and, child and dependent care expense, you're getting the federal one. These other credits, you're not going to see these at the VITA site, typically not. Okay, so this is a busy slide, so let's run through the California Earned Income Tax Credit. And so it says you've got to be making up to a certain amount. That dollar amount changes yearly. And it also talks about investment income. So the federal side of the house, if I remember correctly, I think it's about $11,000. For California, it's about $4,500. So there's differences. So when you enter this data into the software is going to cap it or not allow the individual to receive this credit if they've got investment income at 45.25. And then when you're talking about the particular credit, as we've mentioned before, wage earners and self-employed individuals, and you do have to fill out the form 3514. So you're going to be populating that in the software. And that particular form is called the California EITC form. And going back here, and this is only for California, you can have a valid ITIN. And what that means is that individual taxpayer identification number. So most of the people that we bump into at the VITA site will have a Social Security number. Individuals that are ineligible for a Social Security number, they will apply for an ITIN with the IRS. And it takes a little while to get one, but a letter will go out, dear taxpayer, based on your application, here's your ITIN, and then we can assist them. So again, for the purposes of California EITC, you can get this for an ITIN holder. And again, going down here in these rules, earned income, there are limits, the AGI, and of course earned income. And it says here for California, you're not using a married filing separate or a registered domestic partner filing separate. And again, this is something we don't do in the VITA program. We're not going to prepare a separate return. And then you have to live in California more than half the year. They're pretty basic rules. And if you're thinking to yourself, well, $30,000 and change, that's pretty low. Well, I can't explain all the rules, but I know a lot of individuals come to the VITA site and they may have received some type of assistance from the county or maybe the federal government or both. And so they're able to pay rent, they're able to buy food, and they're living on maybe $25,000 a year. I've seen a lot of that. So you will see that. And then the maximum EITC is taxpayers who meet the requirements regarding adjusted gross income, earned income, and they've got 3 or more qualifying children. So this is the California EITC, a little over $3,500. And for the federal side of the house, I think it's a little bit more than $6,600. So it is possible a low income individual meeting all the rules can get both federal and state EITC payments of a little over $10,000. And when you see that, you might kind of shake your head and say, how can that be? Well, they meet all the rules for both federal and state. And again, refundable credit. So this is something that you see, I've seen this for state of California. They'll send letters to taxpayers, dear taxpayer, we need additional information. And what I tell my pro bono clients, what I tell my VITA clients who want to listen, what I tell my paying clients, if you get a letter from the FTB and they're asking for information, you want to respond to it, because otherwise they're not going to release that refund, or maybe they're going to contact you and say, hey, we need to talk to you as far as maybe an audit.
Jerry,
And
we
then
have a question.
Sure.
On the top line, it talks about the $30,950 limit. Is that adjusted gross income, or is that your California taxable income, or what?
Let's see, that would be, let me see if I can do this off the top of my head. That should be earned income, if I remember correctly. Let me write that down. I may have to look that up. Okay, we'll stay with that for now until I look that up. And then this is something that you see from time to time, both the federal government does it, the state government does it. And I'll just read it because this applies to certain items for the state of California. And so it says, starting with this new calendar year that's coming up, it says refunds, I'll just read it. The refund is not used to offset delinquent accounts except for non-payment of child or family support. So if you got a taxpayer who is in arrears for child support or family support, which is also known, I guess, as family maintenance, that means this is the exception. So they'll use that refund that's due to the due to the taxpayer, or the taxpayer is going to receive it. They'll use that to pay the let me restate that, to ensure that the child support is taken care of. Or stated differently, if you got someone who owes child support, this is a big thing for not only the federal, but also the state of California. And California is going to use a refund to ensure that child support is paid. And unfortunately, and I know this brings up a lot of emotions for people, this is pretty much non-negotiable. You can fight it, you can yell and scream, but at the end of the day, if you owe child support, the state of California is going to do whatever they can to make you pay it through your state refunds, or maybe a garnishment on your paycheck. And again, this is a highly emotional issue, usually for the person who's making the child support payments. All right, any questions about this? And I think I mentioned before, this has been my experience. The state of California, they are much better organized when it talks about taking a refund than the federal government. The federal government, they've got organization, but for some reason, California has been my experience is much more efficient taking these refunds and applying them to, again, to child support in arrears. All right, the young child tax credit, this came out a few years ago, and it's something that's approximately $1,000 and change. And so if you're qualifying for EITC and your kid's under 6, you can get it. Or if you have no earned income, as it says here, then you got a qualifying child under 6, you can get it. And of course, there are limitations. And you're going to see these limitations in many different things. And when the taxpayer asks, well, why can't I get this? My buddy got it. And I hear that all the time. And I'm telling them, well, you and your buddy are two different people, and you do not have the exact same situation. If you had the exact same situation, then you'd get the exact same refund. But I've never seen that on a tax return, either federal or state. And so I tell people that you have a particular situation, and then sometimes you'll find the right line and point to the taxpayer and say, this is why you're not entitled to this particular credit. You make too much money. And they're frustrated, they're not happy about it. But if they understand it and you can explain it, you can show them a document, a franchise tax board document, then typically what happens, they say, okay, I got it. This is the rule that the state of California has put down. And so, okay, understood. And same thing, if you're getting a refund and it's based on this young child tax credit, then it's not going to be used to offset a delinquent account, except again, if you got child support in arrears. And again, I think it's a social policy or a public policy. Governments and people don't like individuals who are not making child support payments. And again, I know it brings up people are pretty excited about it. But at the end of the day, if a judge says you owe child support, then it's up to you to either get the child support order modified because you don't have sufficient income, or to write those checks, or to have a garnishment from your paycheck. And I see a lot of this, and I just tell people, we're not going to get involved in that. We'll show you the way, but at the end of the day, it's your responsibility. So you're going to have to figure it out. And if you know anything about child support, and I'm not a licensed attorney, I'm not a licensed attorney, but if you owe child support, that's something that you cannot bankrupt in U.S. bankruptcy court. And when you get that judgment reaffirmed, then what happens is the taxpayer who owes it, they could be approached years later by the individual who should have received it. And if I'll give you a quick example, I've seen examples where people in California saw one with the guy, he owed all this money, child support, and didn't make payments. And 50 years later, the now I guess it'd be a woman in her 70s. She said, "Hey, you're still around. You have assets. You owe child support. You didn't make payments. I'm going back into court." And went back into court, had reaffirmed the judgment, and got money out of this guy who I think was in his mid-70s. So yeah, unfortunately, not unfortunately, you're going to see this, but unfortunately, you have people who don't make payment. They're either unable or unwilling. The foster youth tax credit, this is another credit that's available. And this is for individuals who are in foster care and they're between a certain age, as stated on the screen. And you're eligible to claim the California EITC. So this is yet another credit. I don't see it very often. I think I've seen it maybe 2 or 3 times. But again, you might have someone who qualifies for that. And then again, same thing. That refund is not going to be used to offset a delinquent account unless you've got child support in arrears. And when you're talking about a delinquent account, and so this would be a delinquent tax account. So you might have a delinquent state tax account, and then you might have a delinquent federal account. But a delinquent state tax account, the rule is it's called the collection statute expiration date. State of California, this is the general rule, has 20 years to collect on an assessment. Federal government has 10 years to collect on an assessment. And so individuals who are not going to pay their tax, they think it's going to go away. Well, it will go away, but it's going to take a number of years. And again, it's been my experience in the state of California, they are much better collecting on a delinquent account than the IRS. I don't know why, but that's been my experience. Okay, renter's credit, and this is it's a small amount, but nonetheless, it helps out the taxpayer. And so if they qualify, which means they're going to be renting a California property, and it has to be for at least 6 months, and that's their principal residence, and they're under a certain amount of adjusted gross income, they can get this non-refundable credit, which again is a dollar-for-dollar reduction of the tax. And this is something that's automatic, and usually what happens in the software, you'll indicate that they're eligible. The software then will apply the rules, and if they get it, great. So you have to be a California resident. You have to be under that AGI, which is listed here. For single filers, it's approximately $51,000. And then you've got to rent for 6 months. And of course, that's going to be your primary residence. And there are certain properties that are exempt from property taxes. So you'll just ask the question. And then you can see here the $60 amount for single individuals. And if you have a married couple or that qualifying surviving spouse or head of household is $120. again, a non-refundable credit. And I've had taxpayers ask me again and again, why did I not receive this credit? I said, well, you probably made too much money, or maybe you didn't rent a California property. But usually it's a phase out. They made too much money. And again, non-refundable. Okay, and then let's talk about the child and dependent care expense credit. This is essentially mirrored on the federal legislation, but again, you have two different situations. You've got the feds and you got the state. So let's look at this, kind of revisit this rule that you're familiar with for the federal one. So what you're doing is you're typically either going to work or looking for work. That's the general rule. And you're dropping off your kid to daycare, or you're having someone watch that kid, and that kid has to be under 13. And so what that means is all the payments that you've made for your child, for your daycare provider or the provider, when your kid is 12, all of that can be used to calculate the credit. And then once they turn 13, you may still have someone watch them. That's I guess that's possible. You're not going to be able to take the monies that you used and use that as part to make the payment and calculate the credit. So let's see. I think that's all we need to know. Typically, that's going to be generated automatically based on your entries for the federal side of the house. And on the federal, if you're newer, the IRS form 2441 will be generated for the child and dependent care expense credit. All right, a couple things, and I didn't see this when I started VITA a number of many years ago, and then I started seeing it more and more and more. You have individuals who are wage earners or self-employed, and what they do is they ask me, Jerry, why do I owe $1,000 to the state? Why do I owe $1,500 to the state? And I'm thinking, well, let me look at your return, but I'll bet you the answer is you had insufficient withholding either at your W-2 job, or you fail to make what are called estimated tax payments. And so we go through the return, and yep, that's usually the answer. And so people ask me, well, how do I avoid this big tax bill at the end of the year? I said, well, you got some options. You can have additional withholding at your job as a wage earner. You can make California estimated tax payments. We typically call them quarterly payments. You can do that. But the bottom line is, and this is also the federal rule, this is the general rule. There are exceptions to this. The general rule is you want to pay 90% of your tax to the state of California during the year, because they also have a pay-as-you-go system. And if you meet one of those exceptions, then great, then you're going to avoid the penalty. But the takeaway here is if you are filing your tax return and you're getting clobbered at the end of the year with a large tax bill, then this is part of that taxpayer education. I share this information with VITA clients, and I tell them you should consider making estimated tax payments or withholding additional amounts at your job. You can do that, again, just to avoid this big payment at the end of the year and the possibility of what is called the estimated tax payment penalty. I personally have, I remember one time I got one of these. I think it was on the federal side of the house. And so I did my research, and I wrote the IRS and say, hey, you know something? I know all about that 90% rule, but I'm one of the exceptions. And so you might find that your taxpayer is an exception. But again, make those payments and share that with the taxpayer. And a lot of taxpayers will tell you, well, I can't afford to make the payments. Well, okay. But at the end of the year, you're going to get clobbered again. And so you want to avoid this. So take money out of your paycheck, make your estimated tax payments, do your additional withholding, or in some cases, do both. And then use tax, I don't see this very often, but it does exist. And it's a question that you're familiar with if you've been in the VITA program. And so I'll use an example. Let's say you purchase a recreational vehicle in South Dakota, and you pay 5% sales tax on that recreational vehicle. And then you drive it back to California and you're going to use this recreational vehicle in California, you're a California resident. So you got to register it with the DMV. Well, when you register it, they're going to say, oh, you bought it in South Dakota, you paid 5%, let's say in that jurisdiction in California, let's say it's a 9% sales tax. So the difference is 4%. That 4% is use tax, and you're going to pay that to the DMV. And so you do see this from time to time. Now, there's certain items that you purchase, and I think I used this in a class recently. So you go to Vegas, you buy a hamburger, and you're driving across that state line, and you paid $3 for the hamburger. You don't have a use tax on the hamburger, even though you're eating your hamburger that you purchased in Nevada, you're eating it in California. There's no use tax on it. And if someone says, well, what items are subject to use tax, then you can go to the California Department of Tax and Fee Administration, and you can see that laundry list of items that are subject to use tax. But certainly a recreational vehicle is those big ticket items. And then SDI, not everybody pays SDI, but a lot of people do. I don't think I've ever paid SDI. I never paid it as a federal employee. I don't think I pay it as a California employee teaching college. So anyway, but SDI is paid by a lot of people. And what that means is your premiums are going to be collected by your employer. The employer is going to remit those premiums, the tax, if you will, to the state of California. And then if you become injured or maybe have a disease and you qualify, then of course what happens is you're going to receive a disability check from the state of California, and that's going to be non-taxable on your California return. And what I've seen, you might have an expectant mother. Doctor says, hey, you need to take off work, and then the expectant mother qualifies for the state disability insurance payments because they've made premium payments. And then what happens is they get a check from California for disability when they're expecting, and then for a certain period after the birth of the baby. And so when you're talking about SDI, it is a tax. It will appear on the W-2. And then when you enter the data in the software, it'll roll over to the Schedule A as an alpha because it is a tax. And then this is something that I heard about, didn't really think much about. This is part of the taxpayer education, show them the way, if you will. So when you see AB, that's Assembly Bill 194. That bill talks about other things other than the California Penalty Abatement Program. But just focused on this program, it says right here, you have a one-time abatement of failure to file or failure to pay. And so what that means is if someone has that, they ask you about it, you say, yeah, you can go ahead and request that from the Franchise Tax Board. We're not going to advocate for you, so we're not going to fill out any forms, but we can certainly show you the way or educate you. So this is something that I think it's fairly new. I don't know how long it's been around, but when you tell me that we're going to abate something, which means we're not going to assess a penalty, that's a good thing for the taxpayer. You also have, on the federal side of the house, you also have a request for an abatement. And I do that for my clients all the time. In fact, it's a standard operating procedure for me. And I'll say, hey, request non-assertion of the penalty or abatement. And in some cases, if you provide sufficient justification, then you might have a penalty that is abated, which is a good thing, at least for the taxpayer. Sean, I think this is a good time to take a break. I'm showing 11:19.
Okay, I agree. We're on a little long. So
All right, so we'll come back at 11:29. Okay, so let's talk about what are called the additions and subtractions on a California return. And so sometimes your software is going to do this automatically, sometimes based on the subtraction, and usually you're going to have subtractions. You're going to have to do it manually. And so what that means is the subtraction is going to be reducing your California AGI. And so, for example, we're going to show you a tax return where the taxpayers have reported a certain item on their federal return, and it's going to be a subtraction on their California return because California does not apply, excuse me, California does not comply or does not conform with the federal government on that particular item. And then sometimes you'll see additions, probably more so subtractions, but the additions, that's something, again, that would be described in the pub 1001. And so if you haven't looked at the 1001, before the VITA season starts, take a look at it, understand some of the basics. And then as you go into the season, you may end up making a subtraction or reducing your California AGI because of California doesn't conform. And usually you'll hear the term conformity or non-conformity. And there's also a term called partial conformity. But for our purposes in VITA, most likely conformity or non-conformity. And then we've already talked about the items that we want to address here as far as the California adjustments. So again, California is not going to tax Social Security. That'll be automatic in your software. And California doesn't tax a California state tax refund, and that should be automatic in your software. Alimony is something you want to make an adjustment for. Again, you want to get the rules. You want to determine if it is indeed alimony. I remember one time talking to a guy, and he was making payments to his former wife. And so I asked a few more questions, and I said, that's not alimony. That's you being generous to a person because you choose to be generous. It has to be ordered by a court official who has jurisdiction. Unemployment compensation, that will be automatic in your software. Your California lottery winnings, that's something you're going to have to make a manual entry for. And then a couple other things you may bump into from time to time. Your educator expenses, not allowed by the Franchise Tax Board. Your moving expenses are only allowed for military members. And so you're going to get this at the VITA site. Someone says, I've moved, I've spent all this money. And you say, well, since you're not a member of the military, you're not allowed that. But it is allowed for the FTB. And that's part of your adjustments. SALT, which is a state and local tax limitation, the $10,000 rule. This was huge news about 4 or 5 years ago. Everybody was up in arms. And you're only allowed 10,000 in your Schedule A as an alpha, and then your software will only allow that amount. And you're thinking, well, what about the rest? And I'll give you a great example. I got a client. He a couple of years ago, he paid $80,000 in state income tax. And then he asked me, Jerry, I see on my Schedule A, there's only 10,000. I said, that's correct. That's a SALT limitation. The difference at $70,000 went away, and you're not going to be able to get a federal deduction for that. Well, there's no limit to the state of California. And then we already talked about the miscellaneous itemized deductions. We're going to show you one of those. This is the takeaway for itemized deductions. On the federal side of the house and on the state side of the house, you have itemized deductions, and they are going to be different. Now, you do start off with the federal itemized deductions, but because the state of California doesn't conform to everything that the federal government does, then you're going to have some of those changes. Okay, we'll leave this up. I don't know if anybody's had an opportunity to mentally digest this, but we'll leave this up for a minute. And what we'll do is we'll go through it, describe it, and then we'll open up the software and we'll show you the various entries. So take a minute and take a look at that if you would. Okay, let's run through this. So at the top, we've got Mario's information. We also have information regarding his total wages, 20,000. Box 3 and 5, it says 22,000. So that tells me there's deferred compensation. And the code D is in Delta is that deferred compensation amount of $2,000. That could be like a 401k, something like that. Usually the codes that you're going to be working with on taxpayers' W-2s will be the code D or the code DD, Delta Delta. And the Delta Delta would be health insurance paid by the employer on behalf of the employee. And then you typically will have withholding, and the withholding will be federal and state. And that's reflected here. And then sometimes, not all the time, but in fact, most of the time, you're going to have SDI payments on a W-2. And I remember we had a volunteer a couple years ago. She came to me and she goes, Jerry, there's no SDI. I said, yeah, that's true, because certain individuals do not pay SDI. And I said, like me, I never paid SDI when I was an IRS employee. And as a state employee teaching at colleges, I don't pay any SDI. I've never paid SDI. And then we've got Lisa, taxpayer wife, her information, she's unemployed, which means she's going to receive that information return 1099-G, and that's 8,000. We've got a daughter. She's a little kid. She's what, about 4 years old, lived in the home. It will ask you in the software and we'll show you whether or not they're a US citizen. And then here is we've got the 1095-A. You can see those line 33 Alpha, Bravo, and Charlie. The amounts are the same, which means you've got the same dollar amount for each month. And this would be for covered California. And we'll show you the verbiage that the software asks about for covered California. This is something that you're going to see again and again and again. When a taxpayer is sitting in front of you, you're going to have the intake and interview information, and they may indicate that they've received a state refund. If they've received a state refund in the current year that you're working, then you're going to look at that previous federal return and you're going to determine whether or not a tax benefit was taken on that previous return, which means they've deducted all of their state tax. And if they did not itemize, they did not take a tax benefit, which means that state tax refund is not taxed on their federal return in the current year. If they did take what is called a tax benefit in a previous year on their Schedule A, then you're going to have to jump into the software to determine if some or all of that California state refund is taxable on their federal return. And then this is something we ask about if you've paid some type of tax preparation fees. I don't know how many new VITA clients the St. Killian's VITA site gets, but if they paid a tax prepare, then what you're going to do, you're going to enter that into the software. We'll show you how to do that. And that will populate on the California itemized deductions. We already talked about renter's credit. And again, you have to rent California property for 6 months plus. No use tax, so that's going to be something we're not going to worry about. And then contacting the individual, typically because of a reject. And I forget, I don't know if Emily's on the call here, but our rejected returns are perfected. And we have to reach out to the taxpayer. Okay, any questions about the fact pattern?
What does the APTC initial stand for? Covered California, right there.
Advanced Premium Tax Credit.
Thank you.
Yeah, that acronym. Yes, and that acronym you're going to see in the software. Okay, so what we'll do then, ladies and gentlemen, let me see if I can open up the software. So stand by. And so, Sean, I'm going to have to close something out and open something up. Let me see here. Yeah, that's not going to work. All right, so give me a minute here. Take a mental break.
Jerry, we did see an IRS tax form momentarily.
I did too. I did too. All right, give me a second here. Okay, Sean, can you see the practice lab?
I do.
Okay, very good. So just a couple things, and again, this is for our new or newer volunteers. When you go to the practice lab, there's a lot of information. You can spend weeks and weeks on this, but if you are going to jump into any portion of this practice lab, spend a little time in preparing a return. They have essentially tutorials, and they're helpful. And then if you want to get additional experience on preparing returns, you've got practice returns with what accountants call check figures under Section 6. And you can ignore the practice return that's married filing separate. We don't do that in our VITA program. All right, we're going to go to the practice area. And then I think I mentioned before, I've only made this mistake about 100 times. You start entering data and you realize, whoops, I'm in the wrong tax year. So in the upper left-hand corner, this is your practice year, 2023. And because we want to display a California return, we're going to have to jump back to 2022. All right, so we're in 2022. I've already entered the data for the Trevinos. So we're going to go ahead and find the Trevinos and open that up and navigate through the return. And you might notice on the left-hand side where it has the truncated Social Security numbers, the laundry list of returns are not in alphabetical order. They're in numerical order. And so if you got a lot here, that's a quick way to find the return, one way to do it. All right, so let's get into the return itself. And then what will happen is when the 2023, in fact, Scott, can I call on you? I think you certified on a number of returns thus far.
That's correct.
Scott, was the 2023 software that you utilized, was it fairly similar to 2022?
Yes, I did not notice a lot of difference. There was a difference in the educational credit form in TaxSlayer. It made you just put in the grant in addition to the tuition and then separate out the other qualifying expenses, presumably for the purpose of it making recommendations as to whether you should get the lifetime credit or the opportunity tax credit, which the recommendations were wrong, but whatever, that's a different issue.
All right, great point. And so when you're talking about the education credits, I think we mentioned this last week, you want to make sure that you conduct that thorough interview and you're looking for out-of-pocket expense for tuition and fees. So if someone has received some type of grant, then you have to account for that. So the example would be, let's say your tuition payments were billed at $10,000 and you received a education grant for $6,000. Well, your out-of-pocket expense is at that point $4,000, and that $4,000 is used to calculate the credit. Okay. All right. So let's go ahead and open up basic information. And we'll just run through this again. So again, we're looking at the 2022 tax year. And for filing status, this is usually not a difficult thing, but you still have to ask the questions. Usually the head of household filing status is the one that you're going to spend a lot of time on, but there is a decision tree in the publication 4012. And so you want to make sure you account for the correct filing status, because when you're talking about individual income tax, your software will look at filing status and taxable income. And then, of course, the individual income tax will be generated based on those two items. So we've got a married filing joint return. If you are new or newer, the filing status wizard may be for you. I've used it many years ago, but I currently don't use it. So we've got married filing joint. We've got our information. And sometimes what's going to happen is you're going to get a name from a taxpayer, and the name will not correspond with the Social Security name. And so you'll ask them, hey, what is your name? And say, oh yeah, on the Social Security card, that is my full and correct name. And so you want to make sure you indicate that, because if not, then there might be a reject, most likely a reject, which now we have to perfect the name. Date of birth, not an issue. It may be an issue for minor children, because I've met some parents. I don't think they're bad parents. They just didn't remember the date of their son or daughter's birth. And so that's why you want to make sure you get that. And if they don't know it, then they can scare up a birth certificate, and then you got your information. Here, we don't have any check marks to these boxes, but just a couple of reminders. When you're talking about a blind taxpayer, that's going to be the tax definition of blindness. And that is their vision is no better than 20/200 corrected, or their field of vision is no more than 20%. And what that means is I've worked with taxpayers who are blind in the VITA program. They're typically going to go to their ophthalmologist, or I think the other term is optometrist, who will issue essentially a document stating this is their vision. But you will see that. So if you indicate blind, what that means is they're going to receive, if they receive the standard deduction, an additional amount. We talked about deceased taxpayers before, and it's really sad. I think one time I almost cried, but you're going to have usually mom or dad come in, and they've got an adult daughter or son, and they want that refund for the adult child that's passed. And so you're going to see that from time to time. We talked about the $3 to the election campaign fund. This is essentially an order issued by the taxpayer to the government to separate funds. And then if someone qualifies, they can go ahead and start receiving some type of payments from the fund if they're running for president. You won't see this at the VITA site at St. Killian's unless Sean authorizes it. If you have military members who've served in a qualified hazardous duty area or a combat zone, then of course there are special tax provisions, just like there are special tax provisions for seniors. There are special tax provisions for Native Americans. And so that's something that you would check. Typically, this is not a difficult thing to do, but you do have some probing questions, and you might end up asking the individual for their Department of Defense form. It's called a DD 214. Let's see, we talked about cryptocurrency, and we do not work with taxpayers who have had what is called a disposition of cryptocurrency, which means they've relinquished title. And now if they've purchased cryptocurrency, we can help them out, but not if they've sold cryptocurrency. And then down here, we got a date of birth. The taxpayers are about 30. Same questions for the wife in this case. And then the address. And then again, you want to capture some type of contact information. And that way, if we need to perfect the return, we can do so. And what I try to do for a married filing joint, I try to get both numbers, because sometimes you can't get a hold of one of the spouses. So you call the second number.
So Jerry, I don't know if it was intentional, but the spouse's name is different on your PowerPoint than what you have here.
Okay, let's come back here. I've made many a mistake, and that might be a learning point for maybe for all of us.
That was his girlfriend.
It was Lisa
Maria?
on the example.
Oh, okay, I've got the wrong name. Yeah.
Yeah, Mario's the
Yeah,
husband.
chalk that up to human error, as they say. But we got a name, and for instructional purposes, we're going to run with it.
All right.
Okay, and then for dependents, if you do have a dependent, Again, the Social Security card, you really got to get that because again, there's a lot of transposition errors. You're mixing up numbers if you have the wrong social. But again, get the Social Security card and you're good to go. I see a lot of the IPPIN, and let me open that up real quick. And so if the taxpayer wants to file their return electronically, they can do so. If their Social Security number has been compromised and they get one of these IPPINs from the IRS. And that's a good thing, electronically filing, because it's safer and it's quicker. Okay, now we're going to go to the W-2. We're going to open that up. And we just have one W-2 from Mario. So we open that up. We have a standard W-2. That's typically what you're going to see in the VITA program. Every once in a while, you'll have an amended or a corrected. And then every once in a while, someone shows up and says, I've got my year-end pay stub, which has all of that cumulative information for the year, but I can't get a W-2 or I wasn't issued a W-2. And so that would be a substitute W-2. All right, so we have our employer information. He works for Bank of the Best. And again, our mantra is and has been, you're going to key the W-2 as you see it. So you'll key it as you see it in the software. That's the general rule. We have wages, $20,000. And in 3 and 5, it's 22. So that tells you we have deferred compensation, typically a 401k. But there's different types of, and as I mentioned before, you got a 403B, you have a 414, you have a 457. Those are all from Internal Revenue Code sections. But again, we have deferred compensation, federal tax withheld. And let's say, for example, on the Social Security tax withheld, instead of 1364, it was 1363. So all you do is make your change and the software will accept it. And then again, sometimes you have a taxpayer who doesn't pay into Social Security. They've got their own plan, but they will pay into Medicare. Okay, line 12 or box 12, this is that deferred compensation. I remember one time someone asking me, Jerry, what are all these codes for? I'm thinking, well, it depends on the situation, but what you can do, you can look at the back of a W-2 or in your publication 4012, and it'll explain these codes for you. But typically you'll work with 2 codes, D, and that stands for deferred compensation, and DD, that's health insurance paid by the employer on behalf of the employee. So we've got a deferred compensation. And don't forget box 13. If it says they're covered by a retirement plan and it's shown on the W-2, then you'll click on retirement plan on the software. Over here in box 14, this is your occupational plans, and you're dealing primarily with the California SDI. And as it says there, it is a tax. It carries forward to the Schedule A. So in this case, I put down $150. Okay. We talked about that in-home supportive service. Once you determine that you've got that medical waiver that Barbara was talking about, here's your box for it. For your California information, as I've mentioned before, typically your state wages will be the same as your federal wages. And every once in a while, that will not be the case. But again, you key it as you see it in the software. And this is something I've seen again and again where the employer state identification number, EIN number, is you got transposition of numbers. You've switched the numbers around. And unfortunately, the reviewer did not catch it. And that's going to be a rejected return, which is easily fixed by the electronic return originator. And then down here, box 17, state income tax withheld. And then that will appear on the Schedule A as an alpha, and also on the California state return as amount withheld. And 18, 19, and 20 not used in the VITA program in California because there's no local jurisdiction in California that has individual income tax. All right, any questions about the W-2? None? Okay, let's move on. And of course, if you had another W-2, you would simply add another W-2. Okay, now we're going to go into our unemployment compensation. And this is going to be your 1099-G, box 1. And we'll open that up. And so we see here that there is some type of identification number keyed as you see it. In this case, it'd be California EDD, but we've got, for instructional purposes, California Unemployment Office. And we've got the unemployment compensation listed here at $8,000. Sometimes you're going to have tax withheld. This is a taxpayer education situation. I'll bump into taxpayers who are, I think the term is maybe chronically unemployed, and they go back and forth for unemployment compensation. Sometimes they're receiving $15,000 or $20,000 in unemployment, and that kind of gets them to the situation where they may have to, or they may want to have tax withheld. And that way they're not clobbered at the end of the year, like I said, with that large tax bill. Okay, so that's all we're going to do there. Continue.
Hey, Jerry, there was a quick question from the chat.
Okay.
So if there's a reject return because of some error, does the IRS notify you what the error was, or do you have to go figure it out?
Well, the short answer is there is an error notification. I'll use the word cryptic. Sometimes it's cryptic. You got to look it up. It doesn't spell it out in plain English, but yes, you'll be notified. And the electronic return originator and Sean, if I'm not mistaken, I think we're going to have Emily at St. Killian's.
Yes.
Yeah, she does a really good job, and she also has worked at Coastline College, so she does a good job fixing those errors. And yes, there is a code that's given.
Okay.
All right. And so now we're done with that. We're going to go over to our earned income credit. And the due diligence, as it says in the language, the due diligence is not going to be reflected in the software that we're going to be using when we're preparing live tax returns. The whole idea behind due diligence is the IRS is trying to reduce fraud, and they're trying to reduce mistakes, but fraud, because in the EITC program, and you can go back many years, it was filled with fraud. So anyway, the whole idea is paid practitioners use a due diligence checklist and they run through it. And the whole idea is you collect the information, you verify the information, but VITA volunteers, if I remember correctly, we didn't do this in 2022, and we probably won't do it in 2023. And I think, Scott, if I go back to you, when you did your certification and used the 2023 software, did you see this checklist?
One time I did, and then subsequently I did not, and I'm not sure why it appeared the first time. I'm not sure why it went away the second time.
Okay. And so thank you. So if you are preparing a return and this pops up, then you can populate it like I did, and then hit continue, and you're done.
For some reason, I left the screen, and when I came back, it did not come back. I just judged it to be a glitch.
Okay. And then I'm not trying to make all of you paid practitioners, because maybe you want to do something else with your life. But if you are a paid practitioner, there are a lot of penalties for not adhering to due diligence. You can see one of them down here. All right, we're going to hit continue. This, I believe, pops up in the real software. And so sometimes you're going to have to answer certain questions in the software in order for the individual to be eligible for one of the credits. Sometimes you'll use the statements, and when you're preparing a return, if you have additional data that you want, this is one place where you can enter data. All right, and now we're in the credit section, and you can see we've addressed the EITC checklist. And let's go to other income here. Get to the income section. All right. So here's our federal status, income, and you can see the various items. I want to point this out because we see this all the time in the VITA program. This is other income. And we showed you that a week or two ago. And so you're going to have certain documents, information returns, or during the interview, the taxpayer will say, I've had this type of income. You'll make a determination. It's subject to taxation. And so you're going to find one of the tabs. Probably the tab you'll open up, maybe the most might be other income not reported elsewhere. And you can see there's a short laundry list, and sometimes you just have to go to other income. Once you make that determination, your 4012 does a good job. IRS publication 525 does a good job. Again, if it is a taxable event. And a lot of times we have prizes and awards, and generally prizes and awards are going to be taxable. Okay, we'll hit cancel. And let's see. Let's go into our state section. And in this case, this is 2022. The state section information is generated. You can hit the blue pencil. And that brings us to the California. Let's talk about a couple of things here. So these are the adjustments to income and the subtractions to income that we talked about. Let's start off with basic information. This is for additional personal information. You can see right here, generally that federal information is going to be transferred to the state. And then sometimes you have to make what we call manual entries. So let's open up the personal information. This is a question that you got to get past, at least in the 2022, is your principal and physical residence the same as the return? Generally it is. So in this case, we put yes. This is fairly new, registered to vote. And in this case, no. Name change. I have seen this in VITA. And if someone says my name's changed, then you want to ask them, did you go to a court? Because you can wake up in the morning and say, my name is now X. Well, in order for it to be official, you have to go to a court that has jurisdiction, and you have to petition for a name change. And then the court has to agree with your petition, if you will, and then say, okay, here's your new name that you've selected. But generally, you don't see that in the VITA program.
Jerry, while you're on this page, let me just mention the register to vote thing. That's actually one of the focus areas for the United Way grant this year, because some law that Congress passed last year says that anybody who's receiving federal grants or assistance has to help people or educate them about how to register to vote. So we all should know where to find. We don't have to help them register or anything like that. But if you don't already know it, all the information you need about how to register to vote is right on that big white envelope that we give to every taxpayer.
Yeah, that's a good point. When I talk to individuals and I find out they're not registered to vote, again, it's part of that, showing them the way. I said, well, if you're eligible, go register to vote, because participate in our representative government. It's a good thing. You'd be surprised how many people don't register, and then you'd be surprised how many people don't vote. I mean, it's not a federal requirement, but yeah, you want to participate in the system. So good point, Sean. Here's an information regarding alimony. And so if you're paying alimony, again, on your California return, this is something that you're going to report if you receive alimony. If you pay alimony, you can take a deduction, if you will. So you've got to know the name of the person. And on your federal return, there's a box for Social Security number. And then every once in a while, you see someone who's got a number of ex-spouses and they're paying alimony to more than one. So that's probably not fun, but anyway, that's where you make your entries. We don't work with the active duty military in the VITA program unless you have military certification. And shameless plug for Coastline, we do have all of our volunteers they're certified on the military module. And so we will work with both active duty and reserve component personnel. All right, a couple of other things, adjustments, subtractions for income. We want to show you that. And there's probably just a couple things that we would attend to for subtraction to income. Maybe the California lottery winnings. That's probably it. These other things you're not going to attend to. We don't do the foreign earned income exclusion, but again, these are the subtractions. So let's go to California lottery winnings. And so you have someone who won California lottery, $100 or a couple $1,000s. Again, it'll be taxed in their federal return. And if it's a California lottery winning, not taxed on their California return. This is where you would enter that data. All right, so we're going to get past this. And those are subtractions from, and then certain subtractions, again, the unemployment compensation is done automatically. Your credits, let's open that up. And so there's various credits. Usually the credits that you're going to be working with in the VITA program will be the child care credit. You've got renter's credit, and you've got that earned income credit and foster youth credit. So let's go ahead and start off with the renter's credit for California. And it says right here, do you qualify? This is that non-refundable credit, $60 for a single person, $120 for a married couple. Okay, we're going to hit that. And then we've got another one we're going to attend to, in this case, EITC and foster youth. So these are the various questions. It talks about disallowance. You don't see this very often, but if your credit, your EITC on the federal side of the house has been disallowed because of mathematical errors or negligence or fraud, then you would say yes. The negligence is a 2-year prohibition from getting EITC, federal EITC. Fraud is a bad thing, and there's a 10-year prohibition for getting EITC. I've seen that before. I've seen it in the VITA program, and I've seen that as an IRS auditor. Okay. Same thing with California. If it's been disallowed, you want to ask the individual. And typically they're going to know because they received a letter of some kind. All right, so I think that's all I want to talk about here. Okay, so let's go back. And then the healthcare. And this terminology, if you're new or newer, this refers to the Affordable Care Act. And individuals are supposed to have minimum essential healthcare coverage, which basically means they've got health coverage from head to toe. There are certain plans that have coverage, but it's not full health coverage, if you will. And most people who come to the VITA site will have some type of coverage, either Medi-Cal, Medicaid, they'll have employment insurance through their work. Or sometimes you got people who are covered by the Veterans Administration, or some people who have purchased health care off the shelf, and they've got coverage. And so this is something we ask about, and we're asking about each and every month. And sometimes that's a little bit more of an involved discussion. And then what happens is when you're talking about your exemptions, you've got exemptions that are issued by the marketplace, i.e. Covered California, and then you've got exemptions that you take on your tax return. So sometimes you're going to spend a little time in these tabs. I think when your state instructor comes out, I think, Sean, that was via Zoom.
Yes, on January 6th.
They're gonna dig into this, and they're going to show you some details on that. Okay, so we'll hit continue and hit exit. Okay, and so I think I want to show you just a couple other things. We talked about the estimated tax payments. And so that means you would go to payments section over here, and you would find that tab that says federal And let's see, here we go. Federal estimated tax payments. And so you ask about that. I see that more and more in the VITA program. You'd open up that tab and you would populate how much the amount was to the federal government and when the payment was made. These are federal estimated tax payments, also known as quarterly payments. And then same thing for the state of California. Sometimes you have individuals that make those quarterly payments to California, and that would be for the state. Open that up, and you would make your estimated, or you would populate it with the estimated payments, and you would make sure that you account for the particular state, and that'd be California. I can't remember how many states have individual income tax. The last time I saw, I think it was like 45. But again, we only deal with California. Okay. Cancel that. And then let's go ahead and go to the return itself. You're going to see a lot of this in the upcoming weeks as you go through the state section. Next week, we're going to talk about this in detail, and that will be preparing the return for electronic filing, and that would be that e-file tab. And you're going to indicate, in this case, yes, it's a practice lab. And this is where you're going to indicate the type of filing. Some people want a paper file. Most people want to electronically file. And most people want a direct deposit. In this case, they have a deposit of about $6,500 refund. And so if the individual indicated direct deposit, then we'd capture the bank information from them and enter that into the software. So in this case, we'd indicated they wanted to e-file with a paper check. And as I mentioned before, I'll try to educate the taxpayer, say, you know, it's safer and quicker to get a direct deposit. And sometimes they say, nope, I want a check. Okay, then check it is. And then for the state of California, same thing. You can, you have this laundry list, e-file with a direct deposit, which means you have to populate the information pertaining to the bank account or a paper check. And then sometimes you want an individual who says, I want a paper return. And then sometimes they want a paper return, which means we're not going to e-file with direct deposit. And so that means we'd enter the data in the software, and then it'll populate or print out on the form 1040. In this case, they wanted e-file with a paper check. And then your information regarding the email, and then there's a personal identification number that is populated. I think that's about it, other than maybe the questions.
Jerry, I had a question.
Sure.
Did you have time to show how to populate the bank account information? Or
We're going to do that next week in
Next week,
finishing
okay.
your return.
when you do that, just a request, because one of the new focus areas for the United Way is taxpayer education and encouraging people to put part of their refund into a savings account. So we generally just send it all to one account, but they want us to encourage people to put part of it into savings. So
Yeah, if the taxpayer is willing to do that, that's actually a pretty good idea, because I can tell you when I used to get my state net tax refunds as a youngster, I would promptly spend them. Okay, your state driver's license, it says right here optional, and so we're going to put not provided. If they do provide that information, then you would populate that for a driver's license number. You might remember this if you're returning, if you're new or newer, we ask certain questions. It does take a little bit of time, but the whole idea is we do receive support from the United Way. And so these are questions that we ask of the taxpayer. And you can see right here, if the taxpayer doesn't want to answer, they'll say, prefer not to answer. And then there's ethnicity questions that are asked. Again, if you don't want to answer them, prefer not to answer. Okay, I think that's all I want to show here. And so you can see this little red thing. It says not ready to e-file. And although this is the practice lab, and if you're new or newer, you cannot e-file utilizing the practice lab. It's not hooked up to the big Iris computer. It's just simulating what we do. And down here, and this is something we go through and finishing the return. What you're going to do, you're going to indicate the return is ready for review, and then you're going to indicate the return is ready to e-file. And then what your electronic return originator is going to do, only give certain individuals permissions to transmit the return. And I've made that mistake probably a dozen times where I give too many people permission to transmit. And they did. And so that's restricted, and that's what your ERO is going to take instructions from the site coordinator and limit electronic filing to a certain number of taxpayers. I stand corrected, a certain number of VITA volunteers, usually a couple, 2 or 3. Okay, so I think that takes care of that. Let's go to the return itself. And let me go ahead and see if I've got that up and ready to go. All right, Sean, I'm going to go ahead and bring that up. So you want to talk to the crowd for about a minute?
Did you want me to talk about the Army Navy game?
Oh, and anything tax related, anything tax
Okay.
related.
Yeah, well, I just want to remind the folks from St. Killian that even though I've been training coordinator for the last couple of years, this will be my first year as site coordinator, so I'm learning just like everybody else. We are, as we mentioned a couple of times today, we have one more training session with Jerry next Saturday. The first weekend of January, we'll be doing a webinar type training with the Franchise Tax Board of California. And then we'll all get together on January 20th to have a little orientation meeting in person. And our first week of tax returns is going to be January 27th. For those of you from other sites, you're going to have to get a hold of your site coordinator and find out when you guys are going to get rolling, when you're going to verify IDs and all that stuff. But it's just around the corner.
Yeah, it's coming down the pike real fast, isn't it?
Yep, Santa comes and then the Grinch comes right after.
And, you know, if you are newer, I think we've mentioned this once before, you have all sorts of support. You've got Sean has been doing this for a long time. You've got guys like Scott, you've got guys like John. They've been doing this for a long time. And so you're not alone. If you bump into an issue that's a little bit more complicated than what you're used to, there's always someone there that can either find the answer or knows the answer. And as I tell people, there's no shame in looking up an answer. I've done this thousands of times. People say, Jerry, why do you have to look up the answer? Well, the answer is simple. I don't have this all memorized. I have some of it memorized and the other stuff I don't. So I look it up and I usually know where to go. And so this is the support that you have. You have a lot of great people. I boast about St. Killian's because they've got a lot of great preparers, a lot of dedicated people. And so you're definitely not alone. You're going to be okay. So if you get stuck, simply ask for the assistance and someone's going to come by and you're going to get the help. Sean, can you see the practice lab return and the invoice?
Yes, I see the printout.
Okay, great. So what we're going to do, we're going to run through the federal and state return. So you can see this is the first page, and no, we don't invoice our clients, but this is based on professional tax preparation software. So we've got our taxpayer with all the various forms. This is a roll-up that you're going to see, and this roll-up includes the taxpayers, their administrative data, and then what is called a quick summary for federal and state. And I got it. Most people are going to focus on the refund. I guess I would too. And then you have facsimiles of the W-2. And when we print out this package, usually we give them the facsimile. And you can see over here that deferred compensation. And then, of course, we've got the wages and the Social Security wages and the Medicare wages. This is something you get very familiar with. This is the 8879. There's a state one also, and this is the e-file authorization, which lists a couple things to include the amount of refund or what they owe. And then what happens is the taxpayer, once they're happy with the explanation, they'll sign the return. I stand corrected, they'll sign the 8879. And then once that's signed, our e-filer will e-file the return. And usually when we e-file the federal, taxpayer wants the state return to be e-filed. All right, here's our 1040. Take a look at that real quick. Our administrative data is at the top. We've got our child, Gigi, that we entered, and that's something in the software. You hit the dependent tab and enter the data for the child. In this case, child tax credit. In one of the publications, it says it's automatic, and so all you have to do is plug in the information regarding the age of the child and the SSN and the child's name. There are wages, 20,000. Here's the other income, 8,000. Total income is 28,000. You're going to hear this term again and again, adjusted gross income, AGI, and that's simply defined as total income less any adjustments to income that you have. That's all it is. And then, of course, to get to that taxable income, that's our goal. You're going to take your AGI less your standard or your itemized deduction. And in this case, they're going to receive the standard deduction because they have itemized deductions, but not enough to overcome the standard deduction. And this is the amount for most people. If you have a taxpayer who's a senior, 65 or older, there's an additional amount to the standard deduction. If you have a taxpayer who's blind, and there's an additional amount to the standard deduction, which is populated automatically. Here is the remaining amount, taxable income. Sometimes in the VITA program, you will have negative taxable income. And if I remember correctly, it'll show 0. But again, negative taxable income simply means they don't have any taxable income and they're not going to pay any tax. You can see right here, the individual has tax of $211, but there is an adjustment to income. And, or I should say there's a credit, there we go, a credit. And we'll show you that credit. That credit offsets the income, which gives them a total tax liability of 0. And that's probably as good as it gets. And then here are the withholdings. Withholdings sometimes from 1099, in this case, a W-2. And so now we've got 0 tax. And so all these withholdings and credits add up to a refund. So we got EITC, and that's pretty substantial because the taxpayer is lower income and they've got that child, and then additional child tax credit calculated automatically. And then you've got an amount here, which we're going to talk about, line 31. So all of this adds up to the various credits and withholding, and that would be the refund of $65.47. And then Schedule 1 has the additional income on page 1 and the adjustments to income on page 2. And so on page 1, these are the additional income items. In this case, unemployment compensation. And in the VITA program, you're going to see gambling winnings. You may have cancellation of debt, which is generally a taxable item. You might have jury duty pay. You might have prizes and awards. So you might have other income items that'll be populated on Schedule 1, page 1. If you go to Schedule 2, page 2, these are adjustments to income. Typically, you'll see educator expenses, K through 12. You might have that 1/2 self-employment tax deduction if you have someone who's self-employed. You might have penalty on early withdrawal of savings. That's when someone has a certificate of deposit and they break that certificate of deposit, and the penalty is interest. I see more and more alimony paid on those older divorces. And so this is an adjustment, i.e. they can take a deduction on that older divorce, not on the newer one. Student loan interest deduction, a lot of people are paying on student loans. And not just for the youngsters. I have seen taxpayers who are in their mid-60s. In fact, I think I saw one who's in her early 70s and had a student loan interest deduction. Maybe they went to school late, I don't know, but you're going to see that. And when you do see that, there are limitations. But again, you want to ask about that. And another big one, and this is part of taxpayer education, people ask me, Jerry, what can I do to reduce my tax bill? I said, well, one thing you can do is you can open up an individual retirement arrangement and you can make a contribution. And if you qualify, this is going to be an adjustment to income, which reduces your taxable income. And that's one thing they can do is reduce their tax. Pay or Schedule 3, this is your non-refundable credit. This is the retirement savings contribution credit, which is based on the 401k contribution. And this is important when you're talking about the credits. There's actually a ranking of credits or a chronology of credits. And so what happens is certain credits will kick in first. So this one kicks in first and reduces that $211 of individual income tax. And that we saw that tax liability of 0. Okay, so we've got that. This is something that you'll see from time to time. We entered, I guess I blew past the, I'll have to do this again next week. And we made the entries for the Affordable Care Act. And in this case, the individual was going to receive what is called the net premium tax credit, which simply means their subsidy was too low. And this is a good thing. This is a good thing. And so this is a credit they're going to receive. We saw that on page 2 of the 1040. You can bypass this because, again, we took the standard deduction. Earned income tax credit. This is one of the forms that will show up populated. And this is the for Gigi the kid. This is your 8812 talking about the child and credits for qualifying child and other dependents. There we go. And we're going to go past this. Here's your credit for qualifying retirement savings contributions. This individual had a $2,000 contribution to his 401k, and that is used to calculate the credit. And you can see down here information regarding calculating the credit based on the contribution. And so the credit is only the amount of the individual income tax. Reduce it dollar for dollar, non-refundable credit. Here's that premium tax credit. So we made entries into the software, at least I did, made entries into the software based on the 1095A as an alpha. And you may have heard a couple of folks talking about the advanced premium tax credit. And that's the acronym was APTC. This is the name. And you may have heard the term reconciliation, and that's what you have to do when you file or when you receive the subsidy from Covered California. You have to conduct a reconciliation, which means you have to file a tax return. Now here, and next week, what we'll do is we'll have to go through an example in detail, but typically what you're going to see on Covered California, you're going to have that amount from 33A, B, and C, and you're going to key it as you see it. And in this particular case, the taxpayer then has conducted a reconciliation, and the software has determined they have received too little of a subsidy, and that's the net premium tax credit. If they've received too much of a subsidy, then line 27 will populate, and that's the excess advance premium, the excess advance payment of the premium tax credit. We're going to go past that. I don't think you're going to see that on the live software. This is your credit limit. Again, your non-refundable credit, because there is only $211 of individual income tax, then all that can be wiped out is 211 on non-refundable credits. Okay, we're going to go past this. And then we're going to go to, we'll ignore that also. More EITC information. I don't explain this to any of my clients. My paying clients, if they want me to explain stuff, I usually go through about maybe 5 minutes of explanation. That's probably what you're going to do on the VITA site. You cannot explain line by line. You can't spend 8 hours with the VITA client. That's not going to work. Okay, here's our California return. And you can see that in this particular case, we've got the personal exemption, and that is mom and dad, $140 a piece. That's increased in 2023. And we've got the dependent exemption of 433. So these exemption amounts are going to be non-refundable amounts, if you will. Okay, let's get into the guts of the state return. So we have the amount of wages. We have the federal AGI that included the itemized deduction for California. I stand corrected. The unemployment compensation, which happens to be a subtraction, and that's at 8,000. And so now we're down to 20,000 because, again, California doesn't tax unemployment compensation. Here, California has a different itemized deduction amount, and that's for this year, a little over 10,000. And so if you take your 20 minus your a little over 10, you're at about 9,500 and change for your taxable income. Your software is going to calculate your income based on your filing status and the taxable income. In this case, it's $96. We have these exemption credits, which wipe out the 96. You're not going to get any of the difference back. So you're simply going to offset that $96. So now you're down to a zero tax liability. The non-refundable renter's credit kicks in, but again, we've already eliminated that tax. So this shows, but you're not going to get a benefit on your return because it's non-refundable. Here's your EITC. I stand corrected. Here's your California income tax withheld, 500, and that's from the W-2. And then you have EITC, a small amount. Again, the rules are different for California, and that young child tax credit, a little over 1,000. So here are the total payments, withholding and those refundable tax credits. And then that total amount of $1,644. That's going to be the amount of the overpayment. Here's that section talking about the various contributions. And so I think we all probably agree these are good funds to donate monies to, and you can do that right from the tax return. It would simply reduce the amount of the refund. But again, I think we can all agree these are good funds to contribute to. And then the latter page, you can see that we have the amount of the refund is $1,644. And then, of course, once we populate, and Sean, we're going to show this next year regarding the bank information. We have to capture the American Bankers Association routing number, the account number, and what type of check, what type of account we have. And once we populate that, then we can either get a direct deposit or, if they owe, a direct debit. All right, we're going to go to the California adjustments. And that's exactly what this page is, the Schedule CA. What you're doing is you're adjusting. Usually the software does it automatically. Sometimes you have to make some entries manually, but you're making an adjustment between the federal amount and the state amount. So you have subtractions. Again, the example is the unemployment compensation, and sometimes you have an addition. So we're going to go through this. This is page 1. Here you have the, and I'll show you here. Let me go up a little bit. This is column B as in Bravo, and these are subtractions, and that subtraction is for unemployment compensation. This is more of the same, if you will. These are additions to income. Typically, you don't see that in the VITA program. And then the total amount of subtractions were $8,000, which we've talked about. Section C, more adjustments to income. And let me get down to the itemized deductions. Okay, so for itemized deductions, you may have a standard deduction on your federal return, and you may have itemized deductions on your state return. So you can see the various amounts. We start off with the itemized deductions from the federal return. This is done automatically. And here is a subtraction. In other words, the $650 of state tax is listed there in column B as in Bravo. And then you have, again, information based on the federal return. And sometimes you have a subtraction, sometimes an addition. Down here, this is where you would show tax preparation fees. This is entered in the software on the federal side of the house, but you can't take a deduction for it. And this is something that you can take on your California itemized deductions. And let's see. So we have our itemized deductions, and then we also have the standard deduction for California. And it looks like we took the standard deduction for our taxpayers. And so we've gone through all of that, and they still end up with the standard deduction. Let's see, and let me do this. Sean, I'm going to go ahead and go back to the software. And I'm going to see if I can show, first of all, we can find the software. Yeah, let me close something down here. So talk for another minute, Sean. Let me close something down.
Let's
Say
see.
something.
Clayton had a question about, does the practice lab provide feedback such as missing info or errors? And it only does it in the same way that the regular tax layer does. So if there's mandatory information, it'll have a little asterisk next to it. But if you leave that blank and you try to go to the next page, it's going to circle that thing in red and make you fill that
Yeah,
information.
and that's another thing. When you're going through the software and you get that error indication, it's not like you're a bad person. I mean, we all make boo-boos. So you just go and you correct it. That's all you need to do. You just make the correction.
Yeah, but
Yeah,
most
go ahead, I'm sorry.
the feedback comes from if you go through the little training modules in TaxSlayer, Link and Learn, and then I'll just give a plug also. There's some pretty good webinars that the IRS puts on, and on that front page of the Link and Learn, all those little blue tabs, if you scroll all the way down to the very bottom, that's where they put their little video webinars.
Yeah, and what you'll find when you're talking about the software, you'll find that when you first utilize the software, you may have some issues. You try to navigate through it, but once you've navigated through it, maybe about 5 times, you're going to be in pretty good shape. And if you get stuck, it's real simple. You'll find someone in the room, and that person in the room will say, click here, and off you go. But it does take a few times to get used to it. I'm logging in here, Sean.
Last time
Okay.
I actually did taxes was in 2000, 2000. And so I just want to get a little bit more practice in before the tax season starts up. That's why I was asking.
Oh, okay.
Oh, yeah. And then you're going to find some people that are really good with the software. And then you're going to find other people that are really good with the tax law. And if you find someone who's really good with the software and the tax law, then you're in business. But again, it just like anything, it just takes time to navigate through the software. And if you're brand new, it's like any program. You're kind of navigating, you're stumbling through, and then eventually you figure it out.
Yeah, and there are 7 different practice examples on Link and Learn that you can practice through the lab, and there's 7 from last year too. So if you're trying to just get more comfortable with software, I say jump into those 2022 examples first, because they'll work for federal and state. And then in January, the 2023 stuff worked for the state as well.
Yeah, and my site, most of my volunteers, after they do about 5 returns, they feel pretty comfortable. And by the second or third week, they're cooking with gas, as we say. All right, let me point out a couple things that I ran past and I didn't show the crowd. And so when you're talking about tax preparation fees, we're looking at the software here. We come down here to other itemized deductions. Now, on your federal return for tax year 2022, tax year 2023, you cannot deduct tax preparation fees. The reason we enter it here is because it's going to roll over, carry over to the California itemized deduction. So this is where you would capture that. And then as far as the health insurance, that tab, this is where you would enter data regarding the 1095A as an alpha. And I've indicated, yes, they're in covered California. So we go ahead and open that up. This is what is called the tax family, mom, dad, and the young child. And then these are the questions that are asked, and they're probably going to be very similar in 2023. It talks about the advanced premium tax credit, and it says, are you required to repay? And the answer is generally no. And then in this case, we have the 1095A where the bottom line, which is line 33, all of the amounts from January through December are equal. And then there's a total at the very bottom. And so in this case, it says, do all Form 1095As include coverage for January through December with no changes in the monthly amount? And the answer is yes. And these are your totals, 33 Alpha, Bravo, and Charlie. And so you enter that. You key it as you see it from the 1095 Alpha. This particular section talks about household income, and it says AGI for dependents. Dependent was 4 years old, didn't work, didn't have any income, and typically it'll be all zeros. The 2555, you're not going to work with that in VITA. This is the foreign earned income exclusion. This is for your taxpayers who are living and working overseas and they have earned income from a foreign entity. And if you are working at a site that has international individuals, then you would prepare a form 2555. We don't do this at our site. I think they do this at Cal State Fullerton, but I can't remember. And as a practitioner, I do this all the time for my clients who live and work overseas. Okay, I think that's what I want to show you. That's what I zipped by without showing you. Okay, so I think we are done, Sean, unless we have questions from the crowd or comments from you.
Well, I don't see any questions in the chat. So if anybody has a question that they're holding back, speak up now. Unmute yourself first. I'm not seeing any. So thanks for everyone. Oh, shameless plug. Our church, St. Killian Church in Mission Viejo, is doing our big Christmas tree lighting ceremony today at 6 o'clock. So if you're in the area and you want to see Santa Claus or the Grinch or a bunch of reindeer running around, we'll have some real snow, snow machines blowing around. It'll be a lot of fun. Hot cocoa, cookies. There'll be an auction for Christmas stuff and just good times.
You know, speaking of shameless plug, and I'm not a shareholder, but if you go to the Irvine Spectrum, I was there last night with my wife. They have a huge Christmas tree and they have a ice rink where people were skating around. Pretty neat scene. All right. So next week, if you hopefully you can join us, what we'll do is we'll talk about finishing a return. We'll do another entry regarding the Affordable Care Act for the return, and then we'll answer whatever questions we can answer, and we'll go through yet another tax return to give you additional experience, if you will, or exposure to a tax return. All right. If there are no questions, then I'm going to wish everybody a wonderful day, and what do they say? Go Army.
And the score is still 0-0.
All right, everybody. Hey, thanks for joining us today.
Oh no, it's 6-0. Army's winning. Ah.
Jerry, you got a quick second before everybody, as everybody's dropping off?
Oh, sure, yeah, go